Street Journal report that the chip maker is preparing to file for bankruptcy. So keep an eye on German-listed Extron. That is a supplier to Wolfspeed. ST Micro, one of Wolfspeed's largest customers, could also be in focus. And we'll also watch Marks & Spencer's in the retail space, guy facing a £300 million hit in terms of that cyber attack.
You could also see effects from the pound into the FTSE. We'll watch that one as it starts to open. Here it is, the opening trade this Wednesday morning. Let's show you some numbers. FTSE 100 flat as we work our way through the initial seconds of the session. We are expecting a little bit of softness, maybe though, to creep in. We'll see what the individual names look like. Marks & Spencer probably is a factor. The IBEX is down by 0.2%. The Stock 600 is down by less than 0.1%. This is not an exciting open thus far. We're looking for another catalyst maybe to come through. The DAX and the CAC are not open at this point, but you do see a FTSE that is weakening to the kind of anticipated level of down around 0.2%. There you go, CAC and the DAX in unison. French and German markets as one today, down by 0.4%. Let's call it 0.3%. Critty, what are you seeing in the sectors?
I mean, broad declines here, and I think you're seeing it sector from sector. I mean, healthcare seems to be certainly on the back foot. Novo Nordisk is one of your biggest weights on this market this morning. But then you've got the likes of SAP, ASML also taking a little bit of a beating as well. So you are, of course, seeing the majority of the stocks lower, and even the ones that are in the green, they're not in the green by much. I'm seeing some of the banks having a fairly decent day. BNP, for example, UniCredit, we know BNP was ex-dividend, I think, yesterday as well, so a little bit of a recovery for that stock as well. But marginal gains, energy in the green a little bit, but that might just be a reflection of the oil story.
Yeah, exactly. That's one of the sectors that's not falling this morning. Food, beverage and tobacco is your best performing sector, which has a sort of defensive flavour to it, doesn't it? And so you see some of those brewery businesses going higher, but there are only 3 sectors in positive territory. Most are in negative. Autos and auto parts, travel and leisure, retail, those more volatile sectors, those are the ones on the downside this morning.
Absolutely. I don't think there's much actually to take away from this market this morning. There's a few individual names that are kind of worth focusing on. UK house builders are a little softer. I suspect that probably means that we are seeing an extension of the rate story into the equity market. It's expected that maybe the Bank of England doesn't cut rates in the way that was originally anticipated, given the slightly warmer than anticipated inflation numbers this morning. So Barrett's a little softer. You've got Persimmon down a little bit as well. So some of those names are certainly coming under a little bit of pressure. But elsewhere, it's hard to discern a particular trend. You've currently got, in terms of the FTSE 100, I think 25 up and 72 down. So the breadth maybe sort of pointing slightly negative.
A few UK themes to focus on. The Gilt Open, worth a quick mention. Gilt's just started trading, of course, because it's just gone 8 o'clock. We had that UK CPI print, the 10-year yield rising a few basis points as a result of that. So we're pricing out some of those rate cuts. That's something that's weighing on house builders, as you were pointing out, Guy. And just as we were talking about UK matters, of course, Marks & Spencer is trading weaker on the back of that cyber attack impact. But we also have JD Sports, which stays in the retail space, smaller player, but in the retail space. That stock is down by 10%. The results surpassed expectations, but that didn't seem to be enough for the business this morning.
Essentially, the pound sort of initially went down on the data, which was slightly surprising. Then it went up a little bit. Now it's come back down again. So basically, there doesn't seem to be that much to see here when it comes to sterling in terms of the overall story. So you'd think that would be something you want to fold in. The stronger pound would be negative for the FTSE 100, but actually we're not. This data looks really tough at an initial read, but actually once you sort of break it down, it doesn't look quite so bad. I think the market's sort of slowly digesting
That seems to be the argument coming out of Bloomberg Economics, at least, that there's services and then there's core services, and on core services they said, yes, it ticked up, a substantial chunk, and more than expected, but it wasn't as big a jump as the headline services number indicated.
You know what's so fascinating, though, is we're talking about potential tax hikes coming down the pike. We're talking about sticky inflation. We're talking about really kind of price pressures across the board, and the BOE rate cuts that are getting priced into the back half of the year. We're still at 134 on cable when it comes to that against the dollar, which really speaks, I think, to the weakness that you're seeing in the States.
The biggest, the euro is amazing.
Yeah.
You got an ECB that is clearly kind of has been and maybe continues to be in cutting territory, and maybe cuts below neutral. I don't know where neutral is, but ultimately, you've still got a weakening dollar.
Yeah.
And the differential between what you're seeing in the States and what you're seeing in the Eurozone is extraordinary.
The dollar today is really fascinating. We'll get back to that shortly. For the moment, though, let's go back to the Qatar Economic Forum in Doha, where Bloomberg's Stephanie Flanders is discussing the global investor outlook with the managing director of the Kuwait Investment Authority and the co-chair of Oaktree Capital Management.
Short-term volatility, lots of noise, but also some structural long-term forces, not least the trends that are pushing up the cost of money relative to the last few decades. I want to talk about how you're approaching investing with your distinctive portfolios and approaches, but I know there's also great appetite for getting to where that exactly is leading you on some of the practical opportunities you see, so I hope we're going to have time for both. But Sheikh Saud, you have quite recently become managing director of the oldest sovereign wealth fund, the KIA. Tell me something about how you think about portfolio construction in this environment.
Thank you very much, Stephanie, and it's great to be here today in Doha. And you said something about starting with noise. I would start off by saying, ignore the noise. If you're a long-term investor, ignore the noise. And how we look about global opportunities, we're going to talk about today about identifying opportunities based on mismanagement of risk. And as a long-term investor, you can't be lucky. In order to be successful, you just can't be lucky. Someone can be lucky in the short term, but over the long run, you can't afford to be lucky. And to successfully identify opportunities, you need 4 key things. You need to have a long-term strategy. You need to put a process around it. You need to surround yourself with the talent to pick the right opportunities. And you need to have the guts to make bold decisions when opportunities arise. And as a long-term investor going into portfolio construction, whether you're a sovereign wealth fund or a pension fund, you need to know where you're going, reverse engineer it, and you'll have a return of capital on average that you need to achieve. But that's where the main problem is, because investors sometimes tend to focus on chasing returns, but not looking at risk. So you have to assign a specific risk profile to your investment. And the perception is, the more risk you take, the more likelihood of a greater return. But that can be deceiving. You can't avoid risk when investing. You need to understand it and know how to manage it. And risk can be deceiving because it's always an absolute number. It's always positive. But the more risk you take, the more the likelihood of a greater return. But the flip side is also true. The more risk you take, the more the likelihood of a lower return. And that's why you need to put a process around it. Because investing is rational, investors are not. And you need to eliminate emotions when investing, and we've seen that in the 6 months of this year. You've seen very volatile markets. You've seen animal spirits come at the beginning of the year, but they went into hibernation. And we've seen it change. And you'd think the world is upside down, but it probably isn't, and probably Howard has to say a few things about that.
How much?
Well, this panel's kind of rigged because we agree so much. But, the essence of investing is appropriately bearing risk for profit. If there's no uncertainty, you're not going to get paid very much. As Sheikh Saud says, you want to have the right mix for your risk tolerance, but you also want to be aware in a long-term sense of where risk is being mispriced and thus where you can get superior risk-adjusted returns without actually taking too much risk. And, the last 15 years have been a very rosy period. Basically, I would say in the last 15 years, the person who took the most risk made the most money. But by definition, that can't be true all the time, or it wouldn't be risk. And yet, when people go through a very hospitable period and risk-taking is rewarded, it builds up. It's self-reinforcing. Just at the time when you should be reducing it, most people are putting on more. So I think risk consciousness and knowing what's right for you and your institution, not merely return maximization.
I think a lot of people would listen to this and say, that's all very well, but it's assuming you can distinguish these things. So Sheikh Saud talked about ignore the noise, but you don't want to ignore the signal, and you somehow have to tell the difference between the noise and the signal. You've talked about risk and uncertainty, but certainly as economist, I consider there's quite a big difference between the two. Risk is calculable, uncertainty is not calculable. It's just a sheer amount of volatility. So for those of us who haven't got a infallible way of telling the difference between these things, how are you confident that you're ignoring noise and not important signals?
I think you need to focus on hard data and not soft data. So I think if you turn off the TV, and I don't mean turn off Bloomberg, but and look at the hard data coming out of the US, the hard data has been coming in very strongly. But investors have been reacting as if it's the end of the world. So what happened in the past month, I think, is quite significant. You went from a bear market to a bull market in 4 weeks. And that's not normal. And that type of behavior meant people were, because fear of missing out is real. That's the emotional part. So people have been buying into a rising market, then selling when things went south. And that means you bought high and you sold low, and you won't be in business investing, buying high and selling low. So, but in terms of signals, I would say it depends on the price that you're compensated on the uncertainty that's there. I think at the beginning of the year, we know there was a new president coming in. We knew about his policy about tariffs. So we knew about a known unknown. So we knew about tariffs. We didn't know what was the impact. So we knew about a known unknown, but we decided to do nothing about it. And I think that's when complacency came in, and some investors paid the price for it.
Howard, how do you distinguish these? I mean, when you say, you particularly emphasize the importance of understanding risk. But are there times when you say, okay, this isn't actually calculable, I don't know what the risk of this investment is?
Well, first of all, we never know the future. And that's where the risk comes in. There was a professor at the London Business School named Elroy Dimson who said, risk means more things can happen than will happen. And it is from the multiplicity of possibilities that the risk comes in. We have to acknowledge that. And, one of my heroes, John Kenneth Galbraith, said that there are two kinds of forecasters, the ones who don't know and the ones who don't know they don't know. And I think it's very important to know which school you're in. But it's our job to deal with uncertainty. We can't run from it. If risk avoidance ends up in return avoidance. We have to knowingly, intelligently take risk for profit. But the definition of the risk we should take is one that we're aware of, that we can analyze, that we can diversify, and that we're well paid to take. And that's basically what I've been doing all my life. And when I started work in 1969, the banks invested in what were called the Nifty 50, and they thought they were investing risklessly in the best companies in America because of the quality of the companies. And if you held those stocks for 5 years until 74, you lost about 95% of your money. And so these people were taking risks they were unaware of, and that's the worst thing you can do. Keynes said that a speculator is someone who takes risks he's aware of, and an investor is someone who takes risks he's not aware of. We want to do it knowingly, not run from it, but and try to emphasize in the long run risks that are tolerable in quantum for us, and hopefully, as Sheikh Saud says, underpriced.
And something similar happened, I guess, for many people who were holding the developed countries.
Bloomberg's Stephanie Flanders there in conversation at the Qatar Economic Forum, speaking to the managing director of the Kuwait Investment Authority, the co-chair of Oak Tree Capital Management. Howard Marks there making some comments around his experience of investing. Let's bring in another expert here in terms of how to navigate these markets. Steve Chevron, head of multi-asset group and a senior portfolio manager at Federated Hermes, joins us around the table. Steve, I love that he talked there about the Nifty 50 because those were the growth stocks of the 1900s, really, right? So you had the Walmarts, you had the Xeroxes, et cetera. What is, I mean, people were investing in that era because growth was unbeatable, and growth has been unbeatable again in the last 10 years or so. What qualifies as a growth stock now?
That's a great question. Look, I think that difference between growth and value creating has been critical. It's explained, in our view, most of the difference in return between U.S. equities and non-U.S. equities. And I think one of the things that's maybe a little different now than it was at that period is how scarce growth is globally, right? Remember, in the post-World War II period, you had abundant global growth. You had Europe was being rebuilt after World War II. That sparked growth. And I'm talking about growth in the widest sense. You had 2 billion people being brought out of agrarian poverty into urban middle class. There was growth that was abundant in the world, but you don't see it today. What you see in the world today is kind of aging demographics, higher debt levels, lower growth levels globally, and what has become unique, and it is a moment in time, I agree, it's not a permanent state, but what is a moment in time and unique is that if you want growth, if you want companies that are able to grow and innovate and develop new technologies, it really is a story about the United States and maybe secondarily China, but certainly primarily in the United States. And what you're seeing is an equity market that's responded to that, right? Tech in the United States is 3, 4, 5 times the size of the index than other developed markets. And so it's that scarcity right now that's driving those returns. Does that last forever? No. Do I think it's over now? No. I think that story still plays out.
Okay, so you're still, so if we see dips now, you're taking the opportunity to get further exposure to U.S. tech?
That is the only thing that we did during the post-Liberation Day sell-off, if you will. You've had these growth stocks really trade between 20 and 30 times over the last 5 or 6 years. You got to the very low end of that range. Even Mag 7 were at a 2-year low in terms of valuation. Again, unless you think there's a real big driving difference between their performance, that you're really undermining AI or growth is no longer scarce, we thought that was the best opportunity to add in a couple of years, and so far that's worked out.
Howard was talking about speculators and investors.
Yeah.
The story at the moment in the States is still buy the dip. Retail has piled back in. The instinct of the last few years has always been FOMO. If there's a dip, I buy it. I'm going to miss out if I don't because the market's going to rally back again. Is that still the right instinct to have at the moment, or does it need to be more nuanced? Because at the moment, it just seems to be this slightly sort of Pavlovian instinct once again, that once the market goes down, regardless, you should buy it.
So I'm going to answer you recognizing that in order to sound smart, you're supposed to be bearish. And if you want to sound like a genius, you're supposed to be bearish with a British accent.
I
have neither.
This is way too reductive.
My entire career is based on this. What are you talking about?
I have neither. And so what I mean to say by that is the markets in the long term operate in long-term flat and long-term up. Long-term up, secular bull markets are built around demographics, and they're built around technology. And in the United States, you have a working age population that's going to grow 5 to 8%. With the rise of the millennials and Gen Z, which is even larger after, and you have a technological revolution around AI and robotics. As long as you believe that you're in that secular bull, and we do, we think that that started in 2013, then you should, any dip should be recovered within 2 years or less.
Right.
That is the feature of those periods of time. And we believe that we're in those. Now, whether or not, this is the end of the tariff volatility, that's certainly an open question in a shorter run. Do we think that this was a dip to buy? Absolutely, and we did. And I think it's the right move because on the back of it, yes, there's the uncertainty around the tariffs. There's certainly a little bit of an economic slowdown that's occurred in the United States. But at the same time, we have pro-cyclical fiscal policy coming. We have deregulation coming. And we think we've hit peak uncertainty. You need to buy the market not when bad becomes good, but when bad becomes worse at a slightly less bad rate. And that's what we did.
I want to explore what a 5% US 10-year yield will do. We'll do that in just a moment. We're going to come back with Steve in just a moment. Steve Chiavarone, head of multi-asset group, the multi-asset group at Federated Hermes, is going to stay with us. If you want to follow what's happening out in Doha at the QEF, you can also do so. Live Go on your Bloomberg terminal is where you will find that. We'll be back in a moment. This is Bloomberg.
to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech. From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Ottawa, Canada, and this is Bloomberg.
Welcome back to the opening trade. You are seeing the equity indexes a little bit weaker today, but not by a major margin, not a major sell-off that we're seeing across the board, but a little bit of a dampening in risk sentiment. Let's bring back our markets guest this morning. Steve Chiavarone, head of multi-asset group and senior portfolio manager at Federated Hermes, joins us around the table. Can we talk a little bit about these deficit concerns? Where it's freaking out the bond market a little bit. Is it doing anything to the equity market?
No, I mean, not at this point. And I think you've got to be thoughtful. It's a little bit more nuanced. If you look at what's going on in the United States relative to the deficit, very interestingly and surprisingly, because I didn't think this was going to be a priority of this administration, they're paying for large swaths of the tax cuts that they're putting through, right? I mean, the tariff revenue, if you assume 10% across the board, is roughly $400 billion a year, which multiply that by 10 is kind of paying for the extension of the Trump tax cuts with the additional $1.5 trillion in cuts. $1.5 trillion in tax cuts being paid for with $1.5 trillion of cuts. So it is an administration that's surprisingly trying to stimulate the private economy, but not add meaningfully to that debt. It is ironic because, we increased that debt by $8 trillion over the last 4 years, and no one really said anything about it.
Well, I mean, we did see some analysis very similar to the analysis you just sketched out from Bloomberg Economics yesterday that suggested, therefore, don't worry too much about what this does to the deficit, and yet still yields go higher, and the market and the Treasury market worries. To Critty's point, what stops that worry coming into the equity market?
So I'm a lot less worried about what I'm seeing in the bond market, even though yields are higher, than what I saw a month ago, right? Because a month ago, when you saw that bond market selling off at first, you saw it selling off with equities moving down, the dollar moving materially weaker. And when you looked through, what you saw is that there were investors that were getting hit with margin calls and liquidating treasuries.
We're not in danger of seeing any of that now? I mean, the dollar is weaker again.
If this really is a U.S. issue, well, the dollar is weaker because of the debt ceiling. What's happening is because we're not able to issue debt, the Treasury is flooding the market with dollars as they pay down the general account. Once you get a deal here and you lift the debt ceiling and you start issuing debt, I think you're going to see the dollar strengthen again. If this was just a U.S. issue, then why is the Japanese 30-year bond doing what it's doing? Why are global yields rising the way that they are? If we have U.S. yields rising alongside the globe, and it's with an equity market that's stable, and it's with recession odds that are falling, that's a very different scenario than what we had a month ago when it was quite unorderly, or disorderly, rather.
But you think the dollar goes back up again? Because this is critical. If I'm a European investor or a British investor, trying to sound smart about what's going to happen in the States, the dollar's a real headwind for me right now. Like, if I'm a euro investor, the Nasdaq is still down by circa 10% year to date. That hurts, and the dollar is doing the damage.
So I've done a little tour of Europe over the course of the last week here, and my observations, just listening to folks, are one, I think they're underallocated to the United States, and I think that there have been a series of trades that have taken hold in the first half of this year: defensive equities, non-U.S. equities, highest quality bonds, weaker dollar. I think you run the risk of getting suckered into those trades. I think that was a brief interlude in what is otherwise a very different story. And that is, it was an uncertainty trade. It was some quirks around the debt ceiling in the United States and what that did for the dollar. I think the second half is about cyclical, stronger dollar and U.S. outperformance. Again, there was a trade away from that.
With a tailwind of the dollar kind of helping me out if I'm an external investor.
You've got a Fed that's not cutting. You have a government that's going to stimulate, at least at some level fiscally. That's not consistent with a weaker dollar, particularly with tariffs. That's not consistent with a weaker dollar. I think that really is an artifact of what's going on with the way that the United States is financing itself right now. That comes to an end once the big, beautiful bill is passed.
30 seconds, really quickly. Are you seeing a material change in fund flows from Europe to the U.S.?
The way I would characterize it is, if I'm a non-U.S. investor and I'm thinking about the appropriate weight in U.S. equities, I think that number should be somewhere between 30 and 50%, given that the U.S. is roughly 60% of the global market cap. In my conversation with institutional investors over the last couple of weeks, it looks like that number is closer to 20. I think that's under-allocated to a part of the world that's going to outperform.
Steve also points something else that's very useful as well. If you run a hotel, put an iron in it. It's a very civilized thing. Okay, Steve, nice to see you. Thanks for stopping by to see us. Steve Chevrolet, head of multi-asset group over at Federated Hermes. This is Bloomberg.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with more episodes of our show, The Deal.
The theme of this season, On the Road. We're bringing you more behind-the-scenes conversations with the biggest names in sports, business, and culture, like Melody Hobson.
I started to study women's sports like an 11-year-old studies baseball statistics, and I got dangerous in seeing up arrows, up arrows.
Susie Wolf.
When you're competing, you're not thinking about any fear or any worries of what could happen.
Josh Harris.
You can't do a good deal with a bad person.
Jay Batt.
At the end of the day, there's never been a better time to be a student athlete.
And more. Stay tuned.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
What I say is I don't think that AI knows everything that's ever happened and how stock prices reacted to everything that happened. So they can emulate the path to success that worked in the past. That's a pretty good skill to have. I believe that AI can't sit down with 5 business plans and figure out which one's Amazon. I don't think they can sit down with 5 CEOs and figure out in advance which one is Steve Jobs. So there are limitations. But of course, most people can't do it either. So I think that just like indexation and passive investing has supplanted much of active management in the large cap stock world, I think that AI will supplant a lot of investing and a lot of investors, but hopefully not the best.
Okay, last question, and you've sort of raised it. Both of you have talked about the mistakes that people typically make, and good investment being about avoiding those mistakes. But I guess good investment is also about recognizing that you too will make those mistakes. So what have you got wrong in the last couple of years?
So I think what you said is absolutely right. And I think it's always about everyone would do something wrong. You can't avoid doing something wrong, but the important is when you do something wrong is to refine your process along the way. And in hindsight, everyone has 20/20 vision, but no one can predict the future. So you need to focus on your process. But I would say two key takeaways for a long-term investor is that it pays off to actively decide to be patient. And sometimes the best investment decisions you make are opportunities you don't pursue. I would put it that way.
But what have you got wrong?
What have we got wrong? See, we've been around for 72 years. So,
and you made no mistakes?
We always make mistakes, but we learn from them. And I think it goes about sometimes you need to keep refining your process, and sometimes you get carried away when things do get right, that you think you're getting them right, but you don't know if it's luck or skill. And I think as now, the easy time of making money is over. You need to keep refining your process the whole time. I think that's what we've been focusing on. I mean, I'm privileged to have a great team working with me, and we've been focusing on process a lot. And I think that's the key thing. People tend to forget about process when things are going right, and they tend to panic when things are going wrong. If you keep your process there and have a playbook and a game plan, you should be ready when the opportunity comes. And I think, to be honest, as the KIA, we've always been ready when things went wrong. I think we've been great beneficiaries of the financial crisis. Maybe we've learned from our mistakes on .com, but in the financial crisis, the KIA played a big role in bailing out the financial services industry. And this man as well has made a lot of money in the GFC. Okay. So I think there's a few things we have in common.
We've not had a concrete example. Well, maybe 25 years ago in tech is the last time you made a mistake, is by the sounds of that. But Howard, very briefly, we're getting shouted at to leave. But where have you, what have you got wrong?
Well, you know, look, we all have our biases. We can't escape them. The most important thing is to understand them and limit their effect. I am a conservative person, and I'm a skeptic with regard to new and not obviously meritorious developments. So that hasn't been a good thing in the last 15 years. That would have held you back in the last 15 years. So I've had to suppress that, and you know, I can't always do it perfectly.
Okay.
I still think those are good values, but sometimes they get in the way.
Sheikh Howard Marks, thank you very much.
Thank you.
Stephanie Flanders in conversation there with the Managing Director of the KIA, the Kuwaiti Investment Authority, and of course Howard Marks, the co-chair of Oaktree Capital Management, having to suppress his kind of inner concerns about what is happening in these markets over the last few years. I want to take you to a different part of the building, out in Doha, at the Qatar Economic Forum, where we find Francine Lacroix. Francine, over to you.
Guy, thanks so much. We're just outside the plenary, actually, so you can definitely see a bit of a buzz and conversations. I am delighted to be joined now by Amanda Stavely, the Chief Executive Officer of PCP Capital Partners. Amanda, thank you for joining us. Now, you've been coming to the region, you've been doing business in the region for a long time. How do you see Qatar right now? We know that they will also do some more LNG projects. That means money coming in. How will they deploy it?
Well, thank you, Francine. It's a pleasure to be with you this morning. But yeah, it's a really exciting time for Qatar, especially, I mean, I've been coming to this conference for many years. It's exceptional, and it was so exciting to be able to see, you know, the new team at the QIA yesterday doing their first interviews. But I think, you know, Qatar have been incredibly good, savvy investors for many years. So I think you'll just see more of the same. I know that the new CEO talked a little bit about private credit. In this market, they've been leaders in that area from, you know, 6-7 years ago. Obviously, the new CEO understands the US market very, very well, so that will be helpful. And although, you know, it is a crowded space, I think, you know, you'll get some exceptional deals in that credit space. So I think it's an important time for the whole region because of the geopolitical thing. So it's important to remember that we need to focus on business sometimes, not just politics.
Amanda, overall, is the money raised in the region staying in the region, or will it be deployed internationally, given all the turmoil and turbulence also that we've seen on the market?
Well, I think it's a lot, you know, a lot of it's going to have to stay in the region. It depends on which country you're in. Obviously, in Saudi, you know, Qatar's gone through its build process, you know. We've been here before the World Cup, and now it's extraordinary. There's extraordinary infrastructure. So their build program has pretty much completed. So they can now redeploy. You know, we went to see some new projects with the Emir last night, which was extraordinary. So I think there's always going to be a combination of domestic agenda is key, but then, you know, Qatar's in a place that it can look towards, you know, other markets, whatever they may be. But with Saudi, you're seeing much more inward investment because they've got a World Cup program, and they've got a young population and a deep population, so they have to prioritize, you know, the local markets.
How much appetite is there still for sports? You've also been instrumental, right, for a lot of sports ventures here. Do you see a growing appetite and in different sports, or still football?
No, I mean, we are not now starting, we're just raising a new sports and media fund that invests across all sports asset classes. So we see continued support for sporting assets. You know, obviously, you know, with Newcastle United, we're so proud of where they are, and and we had the best partners in PIF and the Rubin family to take us through that journey. Amazing fans. But with the also continued success of PSG, especially this fantastic season, they've got an extraordinary team. Big match. I know you've got some passionate fans at home. Some might be on the French side.
The other side.
And the other side. So I think there's going to be continued investment into sports, and it's becoming a much deeper asset class in terms of institutional equities. Always flown in for the past 5 years. You've got a combination of private equity investors, you've got those institutional investors and sovereign wealth funds, and then your high net worths. So you've got a lot of different capital asking for different things in sport, and I think we've got to see how that works. What we have to remember in sport is our viewer, and our young viewers, and young viewers today are increasingly. We've both got 10-year-old boy. Well, I think I've got a 10-year-old boy, and they absorb football very quickly, but their attention spans are not as long.
And so, how do you see that changing? Is it media rights? Is it actually teams are changing, and the way we consume, sports in general has definitely changed the last 5 years?
Yes, I think the media rights landscape will change dramatically, and I think we have to see a much more robust direct-to-consumer model built out over the next 5 to 6 years. The Premier League, which I love and know very, very well, has been, supported by some very solid media rights deals. Those will eventually, in the next 4 years, start to move away, and we have to be able to understand how do our young people, how do we grab their attention, and how do we monetize our assets.
Todd Bowley yesterday was saying actually players are being played too much, that there's a higher risk of injury. Do you see that changing anytime soon?
I think he's actually got a very, very important point. I mean, there's a lot of competitions. When we were just taken in from Newcastle, we moved into the Champions League, and we had to play the Champions League matches, the FA Cup matches, all of those others. Players get injured, and player health is very important. So I could understand how Todd feels. Newcastle had a season pretty much injury-free, but we had 2 years ago we had a disaster. So player welfare is really important, and we need to manage that.
Is there a big deal, another big sports deal on the Amanda horizon?
I hope so. We're looking at a very exciting... Well, we're looking at a number of deals. In football, media, we're also looking at non-sport assets, private credit, and we're looking at a fund that just invested into other funds, fund of funds, and into their general partners. So we've been doing that, and taking a little bit of my eye off the sporting.
Valuations are good right now for possible, or again, because it's been a little bit bumpy, I don't know whether it takes a little bit longer for deals or funds to be raised.
Valuations, I think, have been quite toppy in sport. Depends on your assets. So I think we've been waiting, for valuations to come down a little bit so we can do them. But I think people know good capital is important, and I think it's often we get swayed by valuations. You can always do a deal in the right environment with the right partners, but obviously valuation is pretty critical.
Amanda, you're based in the UK, you're based in London, and I know you've spoken out about some of the things that the new government has put in place, maybe targeting non-doms. What are your peers telling you? Are they leaving London? We're hearing that people may actually move to the Middle East because of some of the things that Labour is putting in place.
London, especially Mayfair, is quiet. It's very quiet, concerningly quiet. But I'm a huge Anglophile. I love the region. It's very easy for me to live in the region. I lived in Abu Dhabi for many years, so for me to go back is very, very easy. I choose to stay, still a UK taxpayer, but I'd like to see the government do more around, attracting people back. It's not just the fact that a lot of non-doms have gone back. It's the fact that all the infrastructure around that has gone. So I think there needs to be a balance. I also think we need to make in the UK our competitive landscape as tax efficient as possible. So, we pay high taxes, high corporation taxes. We need to be as competitive as possible with our European counterparts, else you will continue to see an exodus to the Middle East.
Are you having some of those conversations with the government? Are they listening?
Yeah, no, I think they are. I think government is understanding that there needs to be a change. Obviously, we're in a seismic political landscape at the moment. And I think that there's been so much focus on Gulf. You know, we had COVID, the fallout of COVID, and the issues. So I think we've sort of maybe taken our eye off the business landscape, the tax landscape, and that will probably come back.
Amanda Stavely, thank you so much for joining us today. Real pleasure to speak to you in person here in Doha, Qatar, the Chief Executive Officer of PCP Capital Partners. With that, and I'm going to send it back to you in London. Of course, we'll have plenty more from the Qatar Economic Forum throughout the day.
Absolutely. Thank you very much. Bloomberg's Francine Lacroix, of course, on the ground at the Qatar Economic Forum in Doha. Coming up, plenty more from the QEF throughout the morning. We're live in Doha next. Jumana Basecha in conversation about the global macro environment. This is Bloomberg.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Welcome back to the opening trade, 8:47, so 47 minutes into our European session. And the European equity market picture looks flat and negative, really. Down by 0.3% over on the CAC Caron. Elsewhere, a little flatter. US futures pointing lower. Kriti, there is a little bit of risk off in these markets as a result of some geopolitical nervousness. Oil prices higher, gold prices higher. A little bit of a bid into some of those traditional havens, at least, on the back of some nervousness around the Middle East.
Absolutely, digesting some of the news flow there. But then, of course, it feels like a lot of the focus is what's happening over in the States and what that's going to do to the bond market with ripple effects perhaps to the rest of the world. And that's just one of the macro themes we're keeping an eye on. Let's go back to Doha now, where Bloomberg's Jumana Bersetchi is moderating a panel quite literally right on topic called Riding the Macro Wave, What's Coming Next. Let's tune in and listen for a little bit.
And so I want to kind of just say like what my view on what U.S. exceptionalism means, and then I'll talk about how we invest around that. So I think there are kind of 5 factors that have made the U.S. a really exceptional place post-World War II. The first is that we had very strong alliances. The second is very quickly an act from 1950 called the National Science Foundation Act, which, making it short, was just connecting research dollars from universities into the private sector that has given rise to a lot of the technologies that Rajiv just talked about. Third would be the exorbitant privilege of being the world's reserve currency. Fourth would be rule of law and constitution. And fifth would be demographics, that as a country, we in theory can tap into 7 billion people, whereas, China, the world's second largest economy, has a smaller pool to come from. That's historically been true. I think we could argue we're taking all of those out for a little bit of a test drive right now. But ultimately, I think while some of those formidable advantages are bendable, they're probably not breakable. However, I think both things can be true. I think the U.S. can remain exceptional, and I think it's still possible that investors are going to look to allocate marginal dollars elsewhere. And I'm going to complete that thought, and if we get a second, I want to say something on AI. And what I mean by those marginal dollars is the following. Like, there's a lot of talk about whether we're losing or we're winning. I just want to posit to people that the United States of America has 5% of the world's population, 25% of its GDP, and over 70% of its market cap. So we came into 2025, one might argue, with actually a lot to lose. And I really dismiss the concept that people would allocate away from the U.S. In January. I just said, that's not possible. We are the world's reserve currency. We have all these formidable advantages. There's nowhere better to allocate capital. I actually still think that's true. And the middle market, which you talked about, is, if you add it together in the U.S., the 3rd largest economy in the world. So, I mean, there are amazing opportunities. But what I'm hearing from investors all over the world is, yeah, America's great. And it may stay great. But maybe I don't need to put more than 70% of my capital into that equity market. The UK pension market currently has 12% of its assets in 7 companies that are American. So I just think a little bit of the disruption and chaos has made people look at the portfolios and say, maybe we would, benefit from some diversification. And I'll end by saying a place in this region that we actually are seeing a lot of interest is in emerging market debt as an example, which has actually outperformed, as has Europe, the U.S. in debt markets, surely, and in equity markets as well, in the case of Europe. But back to emerging market debt, half of that index is investment grade. So you have a lot of people, a lot of LPs looking at that and saying, do I want to be with the U.S. IG credit facing tariffs and slowing economy? Or might I be with an IG credit in emerging markets where I can get similar or higher spread? Look at this country, in Qatar. You have a good quality credit that's actually deleveraging. So I just think people are open to the benefits now of diversification. Yeah. And can I just say one thing on AI before? Do you mind if I wanted to make one comment on what you said? Because there was a chart up before about the Mag 7, and have so much more experience in technology investing than me. But one thing I wanted to say, when we look at the future of AI, and we've had a dedicated AI fund for 10 years, I completely agree with what you said. Currently, we have like 70% in the infrastructure, which, by the way, was money losing for the internet. So time will tell. Like, we think this is different. We should argue that. But we have 20% in the software and 10% in what I would call the adapters to it. And I think that's going to shift a lot. And we agree that the winners are going to be the companies that figure out how to adapt themselves. This is a very important point. It might be real estate. It could be industrials. It might be hospitals that could be the winners of that revolution.
Financial services. A lot of industries need to be disrupted. So agentic applications of AI over the next 5 years is where the fun will be.
Yeah.
The companies that apply generative AI.
I want to ask you about a sort of parallel theme, because data centers require a lot of power, a lot of energy. And what has happened in the last year or so, the last 6 months, is the hype around energy transition, around ESG, has fizzled out. But when I speak to people, especially in this part of the world, when they talk about investing in data centers, they tell me a lot of that is actually going to be powered by renewable energies, by potentially nuclear energy. Is that going to give the energy transition basket another push?
Absolutely, and you know, the push for green was good. We will need a lot of energy for many reasons. Data centers, we have 8 billion people on this planet, and of which 3 billion are becoming affluent in India, Southeast Asia, China, and in Africa, whose per capita consumption of energy is going to go up as they become affluent.
We are, of course, listening live to conversations coming out of Doha. Bloomberg's Jumana Bersetchi there speaking to Katie Koch from TCW Group and One Investment Management's Rajiv Misra. Terminal subscribers can continue to watch that discussion. All the events there from the Qatar Economic Forum. LIVE Go is the function on your terminal.
Let's talk about these markets. Katie's on fire. She's on great form as ever, talking about America being exceptional, but are people going to allocate in the same way that they normally or have done over the last kind of 10, 15 years? Morgan Stanley says buy America is still the trade, except for the dollar. Strategists have raised their call on US stocks and, interestingly, treasuries, but still see the dollar continuing to weaken, which kind of maybe throws up different opportunities for external investors as opposed to US investors, which is an interesting kind of way of maybe looking at this. Verily Totel joining us around the table. The dollar, the dollar is weaker this morning once again, and it seems to have been the exception to the exception recently. America has been exceptional, but the dollar has been an exception to that.
Yeah, exactly. You know, I guess you're hearing on that panel there about American exceptionalism. I think the question now is, fine, maybe the American equity market can outperform, but does that still mean you want to be exposed in FX terms to the U.S. dollar? And, you know, if we look at the options market, this is this chart on screen. This is one-year risk reversals on the Bloomberg Dollar Spot Index. So this is a long-term dollar sentiment kind of indicator. And look, that is showing a extreme bearish positioning, most bearish that we've seen on record going all the way back to 2011. So around 15 years of data on this. And I think this just shows that, fine, the equity market can bounce, but that structural thought around dollar weakness might be there, might be pervasive for some time.
Okay, so not a lot of appetite for dollars, also not a lot of appetite for the long end of curves. I was going to say JGBs, but other curves also might apply, fit in that bucket.
Yeah, no, that's right, Anna. It seems to have gone global, yet we have this issue in Japan with the Bank of Japan paring back its asset purchases, yet those Japanese lifers have really not stepped in a meaningful way to be that, you know, fill in that gap. And then we have to talk about what's going on here in Europe. We had a recent vote of the Dutch pension reform that failed. This is just another sign that perhaps these Dutch pensions funds will have less of a reason to hedge, and we know that they're massive whales in the long end of European swap markets. A lot of the reason why the long end in Europe was pinned was because of this hedging flow, and if that continues to be less and less, that's just another factor to drive up global long-term yields.
Okay. A number of different factors working against long-end yields. It does seem as if the Treasury market is definitely the whale in that story. Like, different sizes of whales, they're all pretty big. Valerie, thank you very much indeed. Plenty more still to come from the Economic Forum out in Qatar. I have to say, listening to Katie, she's always good to listen to. We've got some great other guests lined up throughout the day.
Yeah, absolutely we do. We have, tune in tomorrow, very specifically for Jamie Dimon, our exclusive conversation there. The JP Morgan CEO joins Bloomberg on the first day of the Bank's Global China Summit in Shanghai. I've jumped ahead, haven't I? That's not QEF. That's another event, but that is still definitely worth tuning in for. In the meantime, we will have QEF for you, Qatar Economic Forum, and there'll be plenty more conversations. Live Go or here on Bloomberg TV will bring you the highlights. All of that. European equity markets kind of treading water this morning. The Pulse is up next. This is Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Bringing you up-to-the-minute financial and geopolitical news whenever and wherever it happens. I'm Francine Lacroix in Davos, Switzerland, and this is Bloomberg.
From our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday, only on Bloomberg. Context changes everything.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stradwatts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Newsmakers and market movers. This is The Pulse with Francine Lacroix.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacroix here at the Qatar Economic Forum in Doha. Now, let's join Bloomberg's Eric Schatzker as he moderates a panel on the hunt for growth.
That makes sense for people who are willing to take risk in search of growth. Now, before I turn to my panelists, I do want to remind all of you that we'd be delighted to hear from you. A little bit of input in terms of questions from the audience would be most welcome, and they'll come to me and I'll do my best to weave them into the conversation that I'm about to have with these three people here. So don't forget. I think it would be helpful, as I said, to establish a little bit of context. So I want to do the whole elevator pitch thing. I'm going to ask each of our three panelists to tell us in one or two quick sentences who they are and what they specialize in as an investor. Stephen, would you like to begin?
Well, first of all, it's great to be back in Doha, and thank you for hosting us here for this session. At Liberty Strategic Capital, we're mostly focused on technology and financial investing, particularly banks and insurance companies, and in technology across everything from data centers to cyber.
Jenny.
Great. Hi, everyone. I'm Jenny. It's great to be here. You know, as we were coming on stage, I realized that if you want to be an investor, you should be wearing running shoes. Because part of being an investor is you got to just run faster than most people. You want to get ahead of the trend. So Granite Asia, we are a global investor, early venture and early growth. And so what we do is we look for the best entrepreneurs, help to grow them as they grow from 0 to 1 to IPOs and, you know, to public. That's what we do on a global basis.
Marcelo.
I'm Marcelo Claure. I have a few different businesses, but where my energy sits today is having the ability to buy companies, apply AI, turbocharge them, and generate a lot of returns for our family office and my investors.
Terrific. And I would just point out, in addition to what Jenny said, that yes, if you want to be an investor, you need to wear running shoes, and if you want to be a moderator...
Precious.
What I'm most interested in, and I suspect what you're most interested again, is growth opportunities. I want to know from our panelists, what is the single best investment opportunity in the world right now, regardless of industry, regardless of region, that you see, why, and how you're making it available to your clients? Marcelo?
I would say that today, everybody talks about AI, right?
They do.
We have to learn how to divide AI.
Ad nauseum, I might add.
I'll say that most of the money, about $350 billion a year, go what I call the factory of AI. And that is, people are investing in power, investing in data centers, investing in semiconductors, LLM and applications. And it's incredible. Think about it, $350 billion a year. What I'm focused on, and what I do believe single-handedly will be the most value creation, is in enterprises that have the ability to grab the technology and be able to implement it, what I like to say, apply AI. And, you know, we have a really good use case. I'm very lucky to be the largest independent shareholder of T-Mobile in the US, and we made it publicly that through a digital and AI transformation, we're going to generate close to $10 billion of profit. To put things in perspective, it has taken us about 120 years to get $30 billion of profit, and it's going to take us 3 years to add another 10. And what you can do in use cases, in customer service, in sales and marketing, in software development, in the back office, in supply chain management, and so on. And the reason why I say it's the absolute best investment is because what we do is we buy good companies and we make them great. So even if we don't do such a good job, we will always have a great company. So I've moved from being a venture investor, a growth equity investor, to now I see the single-handedly as the most important investment will be in buying incumbents who have an edge and be able to apply AI and make them great.
A couple of follow-up questions. What's a good example of an incumbent? How could you take a company that we might, or an industry that we might know and understand, and turn it into something that's so much better than what it is today that you can create the kinds of returns that you're talking about?
I'll give you an example. A company in the US called K-Health. Today, we're the primary care physician of the world's leading hospitals, Mayo Clinic, Mass General. And the way it works is, our AI will ask you the right questions about your symptoms, be able to combine it with your electronic medical records, combine it with our clinical AI, and in less than 5 minutes, we have the ability to diagnose a patient, prescribe, and develop a cure. And what we do is we grab that information and we pass it on to the doctor, because the doctor, at this point in time, will have the final decision. So what does that do? It drastically reduces the cost to provide service by 90%, and it also provides a much better quality than when a doctor was doing it on his own. So the results are radical. I mean, think about it, 90% reduction while enhancing, that's the power of AI, while enhancing the quality of care that we do. If I go back to T-Mobile, you know, the quality of service at a telco that you're able to provide customer service, when you have something called proactive customer service, what does that mean? AI, on a just-in-time basis, is able to predict if there's going to be an issue with the customer and fix it before it happens. Very different than you calling a customer care and complaining about my bill or complaining about I drop a call and all that. So these are real use cases that we as investors are so lucky that somebody else is investing in the factory of AI.
The second follow-up, why is a telco, why is T-Mobile, a wireless services provider, the right platform from which to operate?
Well, I'm very lucky to be, like I said, the largest independent shareholder. And when you have a company that has 130 million customers, a huge proprietary data set, then you're able to innovate. And we have deep partnerships with OpenAI. We have deep partnership with NVIDIA. And we've done some pretty incredible things. I do believe that the T-Mobile AI transformation, it is basically the largest transformation of its kind. There's no other company in the world that can say, we are going to...
Well, that's Bloomberg's Eric Schatzker moderating a panel on hunting for growth here at the Qatar Economic Forum. Now, terminal subscribers can continue watching that on LiveGo. With me now, Valerie Noel, head of trading at Seas Group, to actually talk about the market, some of the turmoil that we saw over the last couple of weeks. Valerie, thank you for joining us. I mean, it's been a pretty tumultuous, crazy couple of weeks on the markets, but it seems to be that we're back to where we started. What's been the most interesting bit that you've seen playing out on the markets?
Yeah, well, it's true that we had a very sportive April.
And we are back, as you said, from where we were before the 8th of April. I think the retail investor made a big things in the last month. They inject 50 billion in April, 5 billion only on Monday. So they're almost the new market maker of the market. And that's something very new for us.
What do you see gold doing? I know you track, for example, gold ETFs and some of the things that's happening with gold. That's been one of the most interesting asset classes.
Yeah, gold used to be like the edge, and we can almost say now that the gold is a benchmark. We have seen inflow in the gold ETF like 85 billion since the beginning of the year. It's the asset class who's got the most performance since the beginning of the year with 21%. So it really became part of the portfolio construction that we have at the bank.
What do you see changing in the markets overall? If you look at how capital is being deployed, is there anything that you see as fundamentally different? Treasuries, I know, behaved in a different way to what they've had in past crises.
Yeah, well, I think uncertainties, create that you really need to have a very well-diversified portfolio. And that's the aim for us for this year. People used to be very U.S. exceptionalists, US. And we have seen some shift from US to other countries since the beginning of the year, including bonds. And I think really the aim or the goal for the client this year is really to be well diversified, especially with all these uncertainties that we are facing now.
Do you need to chase growth? Again, to Eric's very good panel and the hunt for growth. What does it mean as a head of trading?
Yeah, I mean, you always try to find some alpha for the clients, and but to manage the risk also. So yeah, you need to find the good opportunity for them, and that's our aim, and to limit the risk also, to hedge sometimes the portfolio. So that's it's a big year for us, and.
Are clients asking, for example, to be much more diversified into alternative instead of public markets? There's a lot of talk here in Qatar, for example, about private equity, about the role of credit. How do you see that changing the markets you're invested in?
Definitely, we had a lot of demand for alternative. So I think you should have part of alternative in your portfolio construction in this year, especially in the region, when there is a lot of things to do about that.
How do you see actually capital being deployed in the region? Do you see it, changing? Are they asking for capital that they want to be invested coming back to the region?
Yeah, we have a lot of interest for the region. It's not easy to invest for a high net worth investor. Not easy to invest in single stocks because you need to have a segregated account, that kind of stuff. But yeah, we have good ETF, good funds. So we have more and more interest in the region by our clients.
Will the capital markets actually be deeper in the region in the next couple of years?
Absolutely. You've seen a lot of IPOs coming here, and we have more and more interest. And we just need to have a little bit more. The region needs a little bit more, not open, but give more opportunity for the client to invest. On the legal point of view, like do not need to have a segregated account or need to have an omnibus account. So it's still challenging for a high net worth client to invest in a direct line in the region.
And Valerie, is that actually at the expense of capital markets in Europe? Do you see money shifting because there's a deeper pool here, or can both thrive at the same time?
I think we can both thrive in the same time. Yeah, here, Asia, I think the US exceptionally is a little bit away now, and people will shift the way they invest more globally. We also see opportunity in Asia, China, but everything almost ex-Japan. And we see some interest from clients from Vietnam. So that's one of our themes also this year.
We've seen so much volatility on the markets that it must have been, sometimes your heart must have gone like on the trading floor. Do you expect that to settle down, given a bit of a blueprint, or can it just come back at any time?
I think volatility is here to stay, especially with the tariff. We actually don't know what's going to happen. We're on pause. And so volatility can pick up, one day for the other very quick. And we have seen that by the past. So I think it's here to continue.
I know you said that means that you need a much more diversified portfolio. Yes. But what did you learn from the first bout of volatility?
Yeah, that us, in our point of view, we didn't panic, and I think you shouldn't panic. If you are a well-diversified portfolio and you stuck to, some very quality name and quality region, you shouldn't be panicking. And but yes, you can always protect your portfolio. Everyone protect, the house, your health. but sometimes it's good to protect your portfolio.
Valerie, thanks so much for joining us. That was Valérie Noël, the head of trading at Seas Group. Now we'll have plenty more, of course, here from the Qatar Economic Forum. Also, oil jumping following a CNN report that the new U.S. intelligence suggests Israel is preparing for a potential strike on Iranian nuclear facilities. Now, an attack by Israel would hinder any progress in nuclear talks between Tehran and Washington and add to unrest in the Middle East, which supplies about a third of the world's crude. Well, for more, let's bring in Ross Matheson, OEMEA News Director. Ross, good morning. What do we actually know about any potential Israeli action against Iran and what effect they would have on the region?
Well, these reports have been coming and going now for quite some months, so it's unclear if there's anything new in this latest report. And we know that Israel has, of course, been preparing for a very long time, potentially, to hit Iran's nuclear installations. The question is, has anything changed that might make this more likely than some months ago? I mean, you can see oil today reacting, but not significantly, suggesting that the market doesn't see anything as imminent. But again, is there anything in the calculus for Israel that might see this shifting? We know the Israeli Prime Minister is frustrated about Gaza. He's indicating an even bigger military campaign is about to get underway soon there against Hamas. He's indicated that he sees Iran as being at a bit of a vulnerable point right now, a weak point. He doesn't want them to make progress on uranium enrichment. Perhaps the calculation comes that this is a time to try and attempt this. Of course, it's not without its risks. It would represent a major escalation in tension in the region. And the big question also is, how would the U.S. view this potentially? How would the U.S. president view this? Would he endorse this or see it as something he doesn't want to happen? Of course, he was just in the region where he was stressing the need for stability. He wants an environment for business, for investment, for trade. You don't want a full-throated war happening between Israel and Iran in all of that, Saudi Arabia also. And then there's just the practicalities of this, because hitting nuclear structures deep underground requires help. And there's big questions about the feasibility of being able to even do it. And would other nations assist? Would countries allow flyover of their airspace? Would the US provide some kind of capacity or assistance? So a lot of things we don't know. And the big question really is, again, in all of this, is anything changing in the Israeli calculus that makes this more likely than the reports that we saw 6 months ago?
This comes as the international pressure on Israel's government is also ramping up, Roz.
Well, that's right. We can see Europeans, the UK, Spain, a long critic of the Israeli administration over the situation in Gaza. Again, the concern about aid, which the Israeli government says is now resuming to some extent at least, but again, the humanitarian situation there. And with Israel talking again about really ramping up the military campaign inside Gaza, essentially talking about destroying, flattening Gaza and warning people to get out of the way. And the question is, where can people actually go to be out of the way, in a sense that something bigger militarily might be brewing in Gaza? And so the criticism from the UK, which is that it's going to stop conversations around a free trade agreement with Israel, not a massive trade partner with Israel, but at least a significant one, the EU stepping up pressure. The question is, does that actually achieve anything? Because again, if the Israeli Prime Minister and those around him believe that they need to push forward on Gaza, we've seen, you know, over the past couple of years that they will do so regardless of that kind of pressure. And so whether the EU, Spain, UK and others have any impact on that remains to be seen, because it does seem as though for Netanyahu, he's just got a singular goal here that he's still keeping in mind.
Ross, thank you so much. Ross Matheson there with the very latest on the Middle East. Coming up, UK inflation jumps to its highest in more than a year, fueled by higher energy and water costs. We'll have more on what it could mean for the interest rate path next. This is Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Welcome back to the Qatar Economic Forum here in Doha. Now, UK inflation jumping more than forecast to its highest rate in over a year, prompting investors to pair bets on rate cuts from the Bank of England. Now, for more, let's bring in our UK correspondent, Lizzie Burden. Lizzie, what explains the CPI beat?
Yeah, good morning, Francine. Well, it was initially a shock. You've got beats at the headline core and services levels, and you had the pound spiking to its highest since February 2022 off the back of the data. Gilt yields rising, house builder stocks down. But look, if you look under the surface of this, I've been speaking to our UK economics team, and they're not so worried. So yes, you've seen traders pairing their bets on Bank of England cuts, as you say, to just one over the course of the year. Our chief UK economist, Dan Hansen, says it puts a nail in the coffin of a June cut, but he's not panicked. And the reason is a lot of it comes down to bills. So this was well telegraphed that you would have this one-off rise in bills in April. It's what you see every year. Of course, you also had that rise in the payroll tax and the national minimum wage, but it's not expected to be an effect that you see again and again each month. On top of that, if you look at the underlying services number, that actually fell. And also, the question of whether to worry comes down to whether there'll be second round effects, and that splits the Bank of England. So do you see workers asking for higher wages to make up for the higher inflation? And yes, the chief economist, Hugh Pill, says this is the reason that you need gradual, careful cuts ahead. But actually, our team says that's not the medium view on the Monetary Policy Committee.
Lizzie, thanks so much. Lizzie Burden there, of course, with the latest, and traders moving on the back of that, pairing a lot of bets on these BOE cuts. Now, the president and head of investment bank management at Barclays has told us there are still questions over the dollar's status as a safe haven because of continued uncertainty over U.S. fiscal policy. Well, Stephen Dainton said that as well as traditional havens such as gold and the Swiss franc, investors have also been turning to European equities. Well, he's been speaking to Bloomberg's Jumana Barsechi here in Doha.
Uncertainty, obviously the U.S. policy direction around tariffs, immigration, now taxes that are causing a lot of focus on Treasury yields is probably here to stay. You have a substantial amount of uncertainty in almost every market. And that's why you're seeing investors flock to the safe havens, the traditional safe havens, gold, the Swiss franc, the yen, have all been major beneficiaries. Actually, you've seen people flock also to European equities as a place of stability, hence the performance of most of those indices this year.
How have clients been reallocating their portfolios on the back of those allocations? Are you actually seeing the flows going into the safe havens? Are they sitting on higher cash levels than usual?
You have definitely seen a move towards other safe havens. The traditional safe haven of the dollar is a question mark. And I think as we walk through the next 4-8 weeks, as a crystallization of the tax policy in the U.S. begins to emerge and the fiscal position of the U.S., But we have definitely seen investors move, as I said. European equities have seen a material advance this year, in particular with the focus on fiscal spending in Europe, Germany, of course, but also Italy and Spain, who have done exceptional things with their economies in the course of the last 5 years, are also seeing inflows of capital to them.
Well, that was Stephen Dainton, Barclays president. Now, earlier, we also spoke to the Qatar Airways Group Chief Executive, Badr Mohammed Al-Mir, on his airliner's plans with supplier Boeing. Now, this comes after Donald Trump announced a record order for the aircraft maker during his recent Middle East tour.
We are focused on one type of aircraft for our narrow-body fleet, which is the 321neo, and this is our strategy. We had 9 737-8 MAXs, and those we're basically leasing to Indigo for them to fly to Doha. On the longer term, we have an order of 25 737 MAXs -10. And because we have decided to stick to the 321neos, we agreed with Boeing to replace the 737 MAX -10 with additional 787-9.
So basically they've been reworked as part of the deal with Boeing last week?
Yes, correct.
This deal is not only anchoring in the moment, it's anchoring in the future and making sure that Virgin Australia is strong and thriving domestically, as well as now starting long-haul operations for the first time in 5 years. So it's a really watershed time. It also takes partnerships to another level. So we were already five years we've been working together as businesses and building depth in our partnership with marketing and sales activity. But this takes it to another level with us Virgin Australia starting to fly long haul, but also starting to work collaboratively to figure out where we can lean on Qatar's scale so that we can procure better as a smaller airline. That's very important to Qatar Airways, but also, needs that extra scale and heft that comes with major aircraft orders.
I mean, would you support an IPO? Well, that was the Qatar Airways Group Chief Executive, Badr Mohammed Al-Mir, speaking to me alongside Jane, actually, Hedwika, former Virgin Australia Chief Executive Officer. Now, let's get straight to a panel, Donald Trump Jr. amongst the panelists.
It's so oppressive that you wouldn't even think so. I think it's an incredible opportunity, and what I saw last week looked truly spectacular. It's an entire reset for the future of Middle East-U.S. relations, the business opportunities, and I think it was just incredible to see. It's truly spectacular.
I mean, we're going to talk about the funds, but I know the primary purpose is obviously to invest in American companies, but you also were traveling with the president, and of course there are many business executives who were traveling around with the president as well. What were some of your impressions of the meetings and the energy that came out of last week?
Yeah, I had the opportunity to be in Riyadh and Doha while the president was here last week, and I mean, simply put, it was historic to see that reception from these countries, but also the kinds of deals that were made. We've never seen anything like it. And I think most importantly, just maybe from a geopolitical standpoint, it was a reset of relations between the region and the United States, which I think so many of us have been waiting for, particularly when you contrast it to the disastrous policies of George W. Bush in the region, or even the incoherence of the Obama administration. So to have someone come here and approach this from a realist foreign policy, which is what the people voted for, which is a more realist foreign policy and a policy of peace, I think was welcome not only here, but also at the United States, because it's what the voters wanted.
Don, the Trump organization announced several deals as well in the last couple of weeks. Have you found that it's gotten easier to get business done because of perceived access to the White House?
No, I don't think it has anything to do with that. Again, we spoke about it backstage. I spoke, headlined the Dubai Cityscape Conference in 2007. We've had deals in the regions forever. It's something we've looked at, again, prior to most people finding it sort of acceptable to be over here. So I don't think that's changed. I think it's the fact that we've had these relationships for so long that so many of these things have been able to happen. People have talked about that, but the reality is my father was a real estate investor and a builder for
40 years. It's what we've done. And so as the region has developed, as more of these areas have really expanded, especially in the ultra-luxury sector, which was obviously the focus of the Trump organization, those opportunities have abounded. But we've been talking and doing these things both prior to his presidency and during, for my brother and I, while he had nothing to do with those things.
Yeah, I mean, critics will say that the U.S. government probably shouldn't be doing deals with entities or government-aligned entities that are also doing business potentially with the Trump organization. What do you think?
We're not, the Trump organization isn't doing business with any government entities. They're doing it with private investors. I mean, many of the people in this room probably know them or have talked about them with that. And so, there is a very clear distinction between those things. In the first term, we actually said we're not going to do any foreign deals, even though that's what we did. Yeah. We had done it for years. We just said, hey, we're going to do this. And the reality is it didn't stop the media from constantly saying, you're profiteering anyway. It was like we stopped entirely. Even the deals that were totally legit, it didn't stop the insanity. So this time around we said, hey, we're going to play by the rules, but we're not going to go so far as to stymie our business forever, lock ourselves in a proverbial padded room, because it almost doesn't matter. They're going to hate you no matter what. So we're just going to play the game.
Let me rephrase the question then. Are there any investments or ventures you would not get into because of conflict of interest?
Yeah, I mean, the Trump organization itself wouldn't be doing direct deals with government entities because that's not what they do and it's not what we have. But that would be it. We're just going to play by those actual rules that are laid out by the government. We're going to play by the rules, and it's as simple as that.
Yeah.
And on the 1789 side, I think it's very clear. We only invest in the United States in private companies, and we take minority positions alongside the largest asset managers and most prestigious asset managers in the world. So it's quite simple. And then just if I may step back on the topic more broadly, I find it odd that this becomes a line of questioning, particularly when I look at the previous U.S. presidents we've had, both on the Democratic side, whether it's Bill Clinton or President Obama, who were basically broke when they came into office, have now become magically very rich. So I don't really like presidents that use the presidency as an apprenticeship and become rich later. I think that should be examined more than people who have actually done something in their life prior to coming into politics and then actually take a hit financially. Those are the types of people we should be supporting.
Yeah, I think all of us would agree that nobody in the vicinity or as a close family member should be benefiting from the president's office, position in office. Just on this point also, Amir, both of you started up the executive branch in DC. And again, there's been a lot of controversy around that due to the high membership fees. It's about $500,000 to get access to it. But then again, there's a perception that this is an opportunity for members to get closer to the axis of power.
Anyone who's a member there could get access anyway, so they don't need to go to a club to do that. So that's just a total misnomer. The other thing is that the actual memberships for regular memberships are a lot lower. That's been reported. And in addition, I think this is kind of the theme I want to point out here. What Don and I have been doing before we were invited to be on panels like this, I think only Newsmax was calling us during the Biden administration. Yeah. Not that anyone watches that here, but in any event, we've been doing this for 5 years. When we see a problem as if being censored or deplatformed, as was happening to conservatives in America throughout the Biden administration, we're capitalists. We create other opportunities. That's about as American as apple pie. The executive branch, that club, is another example of that. Frankly, everything in D.C. kind of stinks. So there were no good options to go and have social interactions with people with our ideological views. And so we wanted to create, again, a solution, which is what we do in every part of the economy through our fund. And we created another option for like-minded people as a refuge away from, respectfully, reporters and Democrats.
Yeah.
Well, I mean, perhaps we should talk more broadly even about the greater conflicts thing. I know for me, I get the Don Jr. is the next Hunter Biden. And I said, it's such a false equivalence, right? I've been doing this for a long time. We were businessmen both before. We will be businessmen after my father's presidency. It's what we've done. I didn't become a businessman when my father took office. The difference being we have invested in companies for decades. I saw a problem that was out there. When no one would talk to us, when we were written off the face of the earth in 2020, I still saw the attacks. I started a publishing company, not because I think publishing is the most lucrative industry in the world, but because we had to make sure these voices are heard.
I was the second verified user on Rumble. I helped them set up the pipe that enabled them to go public because the other social media platforms were canceling us. When Twitter threw my father off, we started Truth Social. So we created actual businesses as a solution to the problems that were being thrown at us. We got into cryptocurrency. That's another one I read about, a lot of conflict these days. We got into cryptocurrency because we were debanked. And so it's interesting. I mean, there's many people in this room that in the past I could have called at any time in my life, hey, I need a loan to build a building, because that's what we did. And I would have gotten a call back and a loan in about 5 minutes. All of a sudden, those people wouldn't take your calls. They wouldn't have your bank accounts. And so we did and invested in businesses as solutions. The corollary to that is Hunter Biden, who magically became a businessman when his father took office. He was paid by shady foreign companies to peddle influence and influence American policy. And that's not what we're doing.
So let me just ask you a question before we move to 1789. But I do want to ask you, since you bring this up, free speech, do you still feel that you're censored? Because you're pretty outspoken. You say whatever you want.
I think Elon buying X was a major game changer, but we were censored across the board. By the way, I was on Fox News every day of every week for 5 years, and then the early 2020, after the election, I wasn't on for 2.5 years. So it wasn't even just the liberal-dominated media or social media platforms. We were just off. So again, we created our own solutions. We fought back. Elon buying X changed the game because it didn't become a conservative platform. Liberals just weren't comfortable with anyone being able to fight back. They were so used to anyone putting up a credible argument to them just being shadow banned, just being censored. We've seen that with our own eyes. So we created solutions to all of these things. They're not conflicts. They're a reaction to the market and to frankly, the landscape that was presented to us because, as I've said, we've always been business people who are coming up with us. We're innovators.
I mean, let me ask you about 1789. I believe you've got about $1 billion assets under management. According to the conversations we've had in the back, I understand that the fund will only invest in industries that are aligned with MAGA philosophy. So what is in the portfolio right now?
Well, by MAGA, we mean Make America Grow Again, and that's kind of our thesis, and it comes within this paradigm that we've defined as entrepreneurship, innovation, and growth, which is our own acronym, which we find is a contrast to ESG. The notion that we observed is twofold. One, that the largest companies in the United States had become effectively monopolistic and were suppressing, in many cases, through a backdoor route, constitutional protections. He's talked a lot about the First Amendment. It's a reason why we've made investments in media. You saw the role that independent podcasts played in the election. The landscape is changing dramatically because people are hungry for that type of information. We invested in Tucker Carlson's new company. We invested in Substack, which is a free speech platform on the digital media side, trying to enhance the First Amendment in the United States through the private sector. And then, of course, we won't stop there. We believe the Second Amendment is also very important. Later this month, Don and I and our team will be taking a digital retailer called Grab a Gun public, where you can buy guns and ammunition online just like you can on Amazon, because we have a Second Amendment right. But again, that's an entire area that's been starved of funding in the United States for ideological purposes. And by the way, it's not just about whether we think it's good or bad. I think it's destructive for shareholders. If you look at a study of public benefit corporations, which are companies that behave the way that ESG overlords would love them to behave, since they've gone public, they're down about 80%. So, you can say what you want, but if you're a capitalist, you shouldn't lose money. And by the way, if they want to lose money and do ESG, we're okay with that. Go ahead and do that. But we're going to provide the other half of the country, or probably 75% of the country, an alternative. And that's really the genesis of why we exist. We have now expanded that into, in our opinion, investing in the best disruptive technologies in the United States. And so our basic KPIs is we're looking for TAMs of over $10 billion, companies that are growing over 25%, and we're looking for a liquidity event in 2 to 4 years with 200 to 300% returns.
Isn't there an argument that what was the parallel economy is now becoming mainstream because of the change in thinking?
But someone had to actually do that. Right. It was very unpopular to do these things. We took another company public during the last 4 years called Public Square, an alternative marketplace to the places that were taking advantage of Americans. So many Americans, and it was sort of interesting, we did these things because half the country
was being left by the wayside. Half the country was literally concerned about being debanked. They couldn't get insurance. They couldn't do so many things. And everyone pretended like it wasn't happening because they're in their spheres of New York and LA and Washington, D.C. They didn't realize what was going on with an entire base of probably about 150, 175 million Americans that legitimately had these concerns. They were flagged, by the FBI as being extremists or being terrorists because they bought MAGA apparel or a Bible. This stuff was actually going on in the United States. And so it was an entire segment, half the country, that no one would even cater to. So Omid and I have been discussing this for years, since 2020. And he said someone has to cater to that. That was a big risk. That wasn't that easy because, again, of all the problems that went around that. But what's nice about us is because we took that risk, because we gave those people that platform that they so desperately needed and felt they weren't getting, I think we probably have the most credibility of anyone in the world to do this because we were the ones that had the guts and were willing to put our names, our money on the line to make sure that these people had a chance.
The 1789 is the year the Bill of Rights was introduced in the United States. So, it's very much part of the ethos. Yeah.
So let me come back to that credibility point. Moody's just downgraded U.S. sovereign rating on Friday.
Jumana Bersetchi there speaking to Donald Trump Jr. and Omid Malik of 1789 Capital. Now, terminal subscribers can continue to watch that on Live Go. Elon Musk says he's committed to leading Tesla for the next 5 years and plans to dial back his financial involvement in politics. Well, he spoke to us in a wide-ranging interview here at the Qatar Economic Forum in Doha.
I think in terms of political spending, I'm going to do a lot less in the future.
And why is that?
I think I've done enough.
Michelle Hussein also asked Musk about the recent backlash against Tesla.
One question before we move on to other companies, which is that I wonder if some of what has happened to Tesla in the last few months, did you take it personally?
Yes.
And did it make you regret any of, or think twice about your political endeavors? Because it is.
I did what needed to be done. The violent antibody reaction, and I'm not someone who's ever committed violence, and yet massive violence was committed against my companies. Massive violence was threatened against me. Who are these people? Why would they do that? How wrong can they be? They're on the wrong side of history. And that's an evil thing to do. To go and damage some poor innocent person's car, to threaten to kill me. What's wrong with these people? I've not harmed anyone. So something needs to be done about them. And a number of them are going to prison, and they deserve it. And more will.
You're referring to the attacks on Tesla showrooms, but I think...
Yeah. Well, it's into showrooms and burning down cars is unacceptable.
Yeah.
Those people will go to prison, and the people that funded them and organized them will also go to prison. Don't worry.
But wouldn't you?
We're coming for you.
Wouldn't you? But wouldn't you acknowledge that some of the people who turned against Tesla in Europe were upset at your politics, and very few of them would have been violent in any way. They just objected to what they saw you say or do politically.
Well, it's certainly fine to object to political things, but it's not fine to resort to violence and hanging someone in effigy and death threats. That's obviously not okay. That's absurd. That is in no way justifiable at all. In any way, shape, or form. And some of the legacy media nonetheless have sought to justify it, which is unconscionable. Shame on them.
Well, South African-born Musk also again criticized South Africa's black economic empowerment rules introduced after the end of apartheid, during which black people were excluded from the formal economy by the ruling white minority. Well, Musk accused the government of having openly racist ownership laws.
It's improper for there to be racist laws in South Africa. The whole idea with what Nelson Mandela, who was a great man, proposed was that all races should be on an equal footing in South Africa. That's the right thing to do, not to replace one set of racist laws with another set of racist laws, which is utterly wrong and improper. So that's the deal, that all races should be treated equally, and there should be no preference given to one or the other. Whereas there are now 140 laws in South Africa that give that basically give strong preference to if you're a black South African, and not otherwise. And so now I'm in this absurd situation where I was born in South Africa but cannot get a license to operate in Starlink because I'm not black.
Musk's comments come ahead of a visit to Washington by South African President Cyril Ramaphosa, when Bloomberg's learned that the South African government is planning to offer Musk a workaround of black ownership laws for a Starlink internet service. Well, Jennifer Zabazaja, our chief Africa correspondent, joins us now. Jen, great to speak to you. So is this enough to actually repair the relationship?
Well, you know, Fran, many people are saying that potentially this might be an opportunity to bring down the temperature, especially if you consider some of those comments that we did hear from Elon Musk yesterday. And a lot of the misconceptions, as the South African government has been saying, has been reported and talked about in terms of a lot of the laws within the government. Specifically, when you think about some of those commentaries that Musk was speaking about there, he's referring to black economic empowerment, which is, of course, laws and policies that were put into place after apartheid to help level the playing field to a certain extent. And he clearly still feels concerned and passionate about this. And so what we've heard from President Ramaphosa, at least, is potentially this is an opportunity for him to step in and clear out some of these misconceptions, revitalize relations between these two countries that goes back, of course, decades. And hopefully he can meet President Trump at a place where, you know, they're both Gulf fans. That is on the one hand, but also they're both negotiators. President Ramaphosa was actually instrumental in helping end apartheid behind the scenes with Nelson Mandela. And so potentially them meeting behind closed doors and being able to sort of iron out some of these rules that Trump has potentially been misinformed about, levels the playing field, offers them an opportunity to reset, especially as we look ahead to the G20 later this year.
And Jen, talking about the G20, the U.S. Secretary of State Marco Rubio actually has been talking about President Trump's attendance or not attendance at the G20 meeting.
And that has been the concern and really the controversy around this G20. Will we actually see the U.S. represented? The first two meetings with foreign ministers and finance ministers this year, we've seen a little bit lower level executives that are represented, or excuse me, government officials that were represented. And the question is, will the U.S. be at the table? And if not, what does that mean for other members of the G20? Potentially that gives President Ramaphosa an opportunity as a member of the BRICS community to step in and do some convincing. But this is really where Marco Rubio is saying the U.S. is right now.
We chose not to participate in this year's G20 hosted by South Africa, either at the foreign minister level or the president's level. And it had a lot to do with some of these issues, in addition to some of the issues they brought on their agenda, which we don't think reflect the priorities of this administration.
And of course, Fran, that is those economic empowerment laws that Rubio is talking about. There's also these eminent domain laws that the U.S. administration has been talking about. So potentially President Ramaphosa comes in and clears the air and offers the U.S. an opportunity to be there later. They have said that it is very important. Actually, President Ramaphosa tweeted just how significant this relationship is for South Africa, but also as a part of the G20. And if not, what could that mean for other members of the G20 to step in? Not necessarily something that President Trump wants to see. So it will be interesting to really see where these two sides meet in the middle, potentially what concessions South Africa makes, and then what President Trump does say about his participation later this year. But as Marco Rubio is stating there, there's still a bit of a ways to go in terms of negotiating.
Jen, thank you so much. Jennifer Zabazaja, their very latest, of course, on the G20 coming up. Now, finance ministers who've gathered in Canada for a Group of 7 meeting this week are trying to find common ground on trade issues while avoiding public conflict with U.S. Treasury Secretary Scott Bessent. The Canadian finance minister says G7 countries have started discussing tariffs on oversupplied, low-valued Chinese products.
we started that discussion, but certainly the low-value shipments have created a number of things that we want to discuss amongst ourselves and see how we can progress that discussions, because it's not only about the revenues, but it's really about, the customs and making sure that we protect our respective jurisdiction, that these packages are not used to smuggle things in different jurisdictions.
Some leading democracies have accused Chinese online retail platforms of flooding their markets with low-value goods, and U.S. President Donald Trump has already targeted these items by removing the de minimis exemption with his tariffs on China. Let's bring in Brendan Murray, our global trade star. So Brendan, it seemed tariffs front and center of discussions at the G7 meeting.
Yeah, exactly. So this meeting comes at a key time. We're basically at the halfway point of President Trump's pause on his global reciprocal tariffs. So the countries are coming, the key countries in Europe, Japan, and Canada and the U.S. are going to sit down and try to hash out where we are. So far, the administration in the U.S. has really only gotten a limited framework for an agreement with the U.K. It's kicked the can down the road another 90 days with China. There are some deals in the works with South Korea, Japan, and India, but those are are moving on from the short term into a more medium term track. So these key economies, these developed nations, are going to have an opportunity to discuss ways they might be able to coordinate to crack down on Chinese oversupply, and perhaps ways that they can together lower trade barriers amongst themselves.
Brendan, meanwhile, the UK Chancellor and US Treasury Secretary are set to meet on the sidelines of the G7.
Yeah, exactly. A lot of people are looking at this U.S.-UK deal to see if it's a model that they're going to get. The EU is one of those, and some of those Asian countries that I mentioned are trying to figure out if that 10% floor is there to stay for everybody, or if there's any wiggle room in that. So far, by the looks of it, the U.S. administration is saying you're not negotiating that away. So this conversation between the finance ministers from the U.S. and the U.K. will be closely watched to see if there's any room there to negotiate the details from the sort of broad framework that they've already agreed upon.
Brendan, thank you so much. Brendan Murray there on the very latest, of course, on these trade pacts. Well, that's it from me from the Qatar Economic Forum for now. Coming up, Marks & Spencer warns of a £300 million hit to profit from the cyber attack. We'll have the details next, and this is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Is this a negotiation or the new rules of the game? It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly,
becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
Welcome back to The Pulse. I'm Kriti Gupta in London. OpenAI, SoftBank, and Oracle have embarked on an ambitious journey to build one of the largest AI data centers in the world. In a new episode of The Circuit with Emily Chang, she speaks to Sam Altman and Masayoshi Son about how the $500 billion Stargate initiative came together.
How did you get to talking with Masayoshi Son and Larry Ellison, and how did you all come together?
I did 2 kind of long trips around the world, and a lot of it was to talk to developers and governments, but a lot of it was also to just really try to get my head around the supply chain. On one of those trips, I met with Masa, and we got to speaking about what it would take to do compute at this kind of scale.
Hi, Masa. It's so nice to see you. What conversations did you have with Sam that led to Stargate?
Well, we have a shared vision of AGI coming soon, and we need compute.
Of all the bets you could make, why this? Why Stargate?
Well, I believe in the vision that this AI, the AGI, will change the mankind's life in every aspect. And we are lucky to see this enormous revolution, and I'd like to be part of that. I get excited.
Last month, I came to celebrate your winning and promised that we would invest $100 billion. And you told me, oh, Masa, go for 200. Yeah. Now I came back with 500.
Explain the math to us. How does it all add up to needing $500 billion?
Well, that covers the capacity we think we need for the next few years, given our growth projections. The interesting question is if we knew how to get $1 trillion right now, which we don't, would we be able to deploy that profitably in the next few years? And I'm not sure about that, but I feel confident we can make $500 billion of value back.
$500 billion. He wants $1 trillion. You can catch the full episode of The Circuit Season 3 when it premieres tomorrow on Bloomberg Television. You'll also be able to stream it later on Bloomberg Original. Let's go from the tech sector to the retail sector right here in the UK. Marks & Spencer posting its best pre-tax profit in 15 years, but its earnings overshadowed by a fallout from a cyber attack. Let's get the latest with Bloomberg's Charlie Wells. Charlie.
Kriti, so M&S shares are under pressure this morning, and let me give you 300 million reasons why that is happening. That is the amount in pounds that M&S said this morning they face in a hit to profit from this cyber attack that has debilitated the online operations of M&S. Since the Easter holiday, their website is not able to process customer transactions, and this is happening for M&S, but it is also happening across the British retail space. We are seeing this attack, of course, from that Easter weekend. If you go through the timeline, there for M&S, but also the Co-op saying that they were attacked just a few days later, and then a day after that, Upscale Harrods saying that they were targeted in an attempt, and M&S also saying that customer data was put in a vulnerable position. So it is in this context that we are starting to see risk managers talk about cyber risk as the #1 fear that they have in 2025, according to a survey by Allianz. That is more than regulation, and that is more than even a fire, just speaking to the fact of how big of an issue this is for corporates.
Absolutely. And speaking of corporates, let's get the latest on another. Switzerland's Julius Baer, also in the headlines.
That's right. So the second largest listed wealth manager in Switzerland has reported that they have a loan loss of $156 million related to some real estate developments that they helped finance. Now, this comes as new management tries to steady the firm as they move away from a crisis related to René Benko's Cigna. The bank says that these fresh losses have nothing to do with Cigna, but investors are not liking what they're seeing from this report that came out early because of some Bloomberg reporting. There is some softness in assets under management and net new money that investors this morning don't seem to like.
Absolutely. Bloomberg's Charlie Wells giving us the latest on some of those movers for today. We thank you so much. In the meantime, plenty more to come from the Qatar Economic Forum, including the Franklin Templeton CEO, Jenny Johnson, and Aker Group CEO, Sebastian Bazin. And join us later for an exclusive interview with U.S. House Speaker Mike Johnson. That's live at Bloomberg Television, radio, and online after 2 p.m. London time. Coverage all across the board. Stick with us. This is Bloomberg.
U.S. tech is influencing global markets.
technology is driving business across Europe.
Companies in Asia are betting on tech.
We're micro investors. So as micro investors looking to invest capital, whether it's in private equity or in direct lending, what we're looking for are opportunities to deploy capital at attractive risk return. When we wake up in the morning, we don't seek to avoid risk. We seek to price it correctly. And so in an environment like this, for sure, if you're looking at a portfolio company opportunity, when you think of the value creation plan, you're factoring in now the uncertainty, which undoubtedly will impact the extent to which you're willing to pay for that asset. Now, in our existing companies, in our existing portfolio, the vast majority are services companies. And services companies don't have basically the input issues. But I will say that when we look and we roll up all this data for all of our portfolio companies, and it's quite rich, it's just down now below 1 million employees globally around the world. We're 2,300 at Carlyle itself. But in our portfolio companies, we roll up this data every month. For example, the inventory component of PMI was up about 4 points. I know that's not really news that anybody probably would have focused on, but we could see that happening months ago. So immediately when it looked like the new administration was going to come in and there was the possibility of tariffs, you could see purchasing managers immediately mobilizing to start bringing goods in faster because of the uncertainty factor.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Good morning from our global headquarters in New York City. I'm Matt Miller in for Danny Berger. Welcome to the Bloomberg Brief. Let's set your agenda for the day. Geopolitical tensions flare up. U.S. intelligence reportedly suggesting Israel could be gearing up for a possible strike on Iran. And a criticism from NVIDIA CEO Jensen Huang blasts U.S. chip curbs on China, calling it a failure to hold the nation back from progress. And we continue our coverage of the Qatar Economic Forum with Ashmore Group CEO Mark Coombs. And in this hour, we're going to speak with Abigail Watt of UBS, as well as Lori Calvasina of RBC Capital Markets. We will also go live to the Qatar Economic Forum, as I said, for an interview with the CEO of the Ashmore Group, Mark Coombs. But back to our top story. Oil prices are surging following a CNN report that the U.S. has new intelligence suggesting Israel is preparing for a potential strike on Iranian nuclear facilities. For more, we're joined by Bloomberg's Golnar Motavelli, who leads our coverage of Iran. Golnar, thanks so much for joining us. What's the likelihood of this kind of attack, and would it be sanctioned by the U.S.?
I think it's difficult to say whether this attack is going to be likely or not, because we've heard this kind of thing from Israel before. I think the difference here, and I think one of the key things, is that this report that was published by CNN was coming from U.S. intelligence sources, not from, as it were, or as we understand, from Israeli sources. So if that's the case, it suggests an intention from the U.S. administration to maybe distance itself from the intentions of the Israeli state militarily towards Iran, and to maybe signal to Iran, because obviously we have these nuclear talks, these very important nuclear talks between Iran and the US going on in the background, maybe a signal to Tehran to say, if this is the case, if this is happening, this is not us, we're warning you. So there are different interpretations out there, but definitely the key thing I think to focus on is what's going on in the background geopolitically. which is these nuclear talks between Iran and the US.
Yeah, it seems like that was somewhat of a priority for President Trump last week when he was in the Middle East, saying he doesn't want to leave Iran essentially in nuclear dust, and that he has high hopes for the country if they come to an agreement. Is it likely that Israel would act without U.S. sanctioning the attack?
It's very difficult to say. I think the consensus, maybe, if you speak to analysts and maybe officials who are watching this, is probably not, given the extent to which it feels that Benjamin Netanyahu is isolated on the international stage because of the war in Gaza at the moment. And as you just mentioned, Trump's trip in the Middle East, that was seen as a huge success from the eyes of the Trump administration and indeed the Gulf Arab countries that have drawn closer to him. And in that trip, he didn't go to Israel, as we saw, and there was a sense that Israel and Netanyahu were not involved in that at all. So I think on balance, I think it's unlikely that we would see the United States at this time sanctioning that kind of strike. And maybe that's the way to interpret this report altogether, that this is actually the US signaling that Israel may want to do this. And by doing so, it's giving Tehran a chance to respond in kind.
We are seeing Brent crude rise just 1.4% right now to $66.26 a barrel. How much oil, remind us how much oil Iran is able to deliver right now, even under the sanctions that that the U.S. has imposed upon it?
I think some of the estimates are around, I think the last time that we looked at this using other third-party watchers was something around 1 million barrels a day, but that's probably going to reduce back down because obviously we've had more sanctions from the Trump administration and we've had this strong pledge from Trump to drive Iran's oil exports, as he said, back down to zero, which is what he tried to do in his first term. He never completely achieved that because Iran has kind of developed ways of working around sanctions for years. But the key difference we've seen this time with the Trump administration is that he's gone directly after those Chinese small refiners, those teapot private refineries in China. And that is going to make a big difference and could be key to the extent to which Iran's oil exports are going to come down in the months ahead.
All right, Golnar, thanks very much for your coverage on this. Golnar Motavelli covering Iran for us out of Bloomberg News there in the London office. Now, Sell America is back with 30-year Treasury yields again rising above 5%. And the Kuwait Investment Authority Managing Director, though, saying that being underweight the U.S. is something you do at your own risk. Joining us now is Abigail Watt, U.S. economist at UBS. And Abigail, I guess, you know, the big, bold call behind Sell America is that the dollar no longer reigns, I guess, as supreme as it did. Not that we expect it to fall out of its position as world reserve currency, but that the premium it has commanded will be reduced. Do you agree with that premise?
Look, I think there's many cross currents ongoing at the minute in terms of some of the moves that we've seen across U.S. assets, not just in the dollar. I think obviously you've had the kind of policy uncertainty, both around trade policy, and now I think coming to the fore is kind of policy uncertainty on the fiscal side as well. So I think with these cross currents, I think you're seeing a lot of movement in U.S. assets generally. I think the question around the potential for some of the uncertainty to go away and how much that's driving some of these shifts, I think that's one of the things that will be important going forward. And then as well, obviously, on the fiscal policy side, we continue to see that kind of moving through Congress. I think the question is where that ultimately ends up. And I think in terms of the timing of the bill, you know, the kind of tax cuts versus kind of tax hikes and when spending cuts might come into play, I think that's going to be the really key thing, rather than just the focus on the overall deficit widening that could come from the bill.
What kind of deficit widening are you expecting from Republicans if they can get this legislation through in any kind of shape like the one that's been reported?
Yeah, so the CBO actually released some scoring yesterday of the full bill in its totality, and that would imply around a 2.3 trillion deficit widening relative to current law. I think the key thing to note here is that there's a couple of different dynamics happening. So you're having the extension of the 2017 tax cuts that were set to expire at the end of this year. Now that extension we would see as something that keeps the tax policy unchanged, and we wouldn't necessarily see that as a tax cut that would be stimulative for the economy. So when we're looking at the numbers here, we're trying to think through kind of how much of this is kind of new stimulus, how much of this is new additional tax cuts on top of the extension of the TCJA. And in addition to that, how much of this is kind of spending cuts? You know, what are we seeing in terms of kind of cutbacks on spending? Now, our sense is that the kind of pattern in the bill, it looks like you could see some of those tax cuts coming sooner. You know, a number of the provisions such as kind of no tax on tips and the kind of increase in the standard deduction for seniors, some of these things that featured heavily through the president's campaign, those are set to kind of sunset by fiscal year 2028 in the current form of the bill. But that front loads some of the potential for kind of fiscal policy to boost growth. Our sense is, though, that overall, when we look at the dynamics in the bill, we think that you'll see kind of a couple of percentage points potentially added to growth from fiscal policy in 26 and 27. But when we think about the kind of relative boost that we think we saw in kind of 23 and 24 of around, you know, a percentage point, you know, these numbers look relatively small in terms of the potential impulse for growth in the US.
How, you know, Republicans, Abigail, often say this TCJA must be extended. If not, it would be a huge tax hike on Americans, trying to make the 2017 tax cuts that were supposed to be temporary permanent. How important is that to the U.S. economy? What kind of hit would we take to growth if it weren't extended?
Yeah, so look, I mean, if we look at the scoring of the TCJA extension, so that it looks to be about 4.2 trillion over the 10-year budget window in terms of the extent of kind of revenues lost to the extension of the TCJA. So, I mean, that is a large fiscal cliff that the US would have faced at the end of this year, you know, if potentially that wasn't extended. That is something that is being extended within the provisions that are making their way through Congress in the current bill at the minute. And unlike some of the tax cuts that have been made in addition to that, which are set to sunset at the end of 2028, that has been put in terms of a kind of permanent kind of provision in the bill. So those 2017 tax cuts have been included on a permanent basis in the current form of the bill. I think the question is, with the sunsetting of some of the other actions, I mean, the question would be whether they are kind of ultimately extended in 2028. I think there's a separation here between the kind of near-term fiscal impulse that you could see from the act and then the kind of longer-term deficit implications in terms of debt sustainability.
So what kind of growth are you forecasting now, Abigail, for the U.S. economy, and how many cuts is the Fed going to give us to help get to your forecast?
Yeah, so I think when we look at the kind of balance between tariff policies and fiscal policy, we continue to think that tariff policies will be a headwind to GDP growth this year. So we're expecting the economy to grow below trend at around 0.9% this year. That's a clear step down from the 2.5% rate that it grew at in 2024. We do think that there's some scope for a kind of pickup in growth next year. We think to around kind of 1.5% in terms of 2026 growth. Now, part of that is some fiscal impulse, but also, you know, we are expecting the FOMC to ease policy. We think that they'll cut rates back to around neutral and remove excess restrictiveness this year. So we're expecting the next cut from the Fed in September, and we think that they could deliver around 100 basis points of easing this year. Now, that's predicated on our sense that we think that the unemployment rate will also move higher. We're expecting that the labor market will weaken off the back of the weakening in growth. And if you didn't necessarily see that weakening in the labor market, then I think that could curtail the extent of easing that we do see from the FOMC this year.
All right, Abigail, thanks very much. Abigail Watt there, U.S. economist at UBS. Really appreciate your analysis. We would like to note, by the way, that the Bloomberg terminal is currently experiencing some technical issues which are being resolved as quickly as possible. We'll keep you updated with the latest market information as we can. Now let's get to the other top stories trending on the terminal this morning. UK inflation jumped more than forecast to 3.5%. That's the highest rate in over a year. The jump prompted investors to reduce bets on interest rate cuts from the Bank of England. The pound is now rising to its strongest level since February of 2022. Julius Baer disclosed it is taking a loan loss charge of $156 million related to its private debt business and selected positions in its mortgage operation. The CEO said it's not expected to uncover additional risks that could lead to further losses. The review is its credit portfolio is still ongoing. After the U.S. has removed the de minimis exemption, other countries are considering similar moves at a meeting of G7 finance chiefs in Banff, Alberta next month. The Canadian finance minister spoke at a news conference about those discussions.
We started that discussion, but certainly the low-value shipments have created a number of things that we want to discuss amongst ourselves and see how we can progress that discussions, because it's not only about the revenues, but it's really about, the customs and making sure that we protect our respective jurisdiction, that these packages are not used to smuggle things in different jurisdictions.
So the translation there, you may see more tariffs coming from other countries on cheaper Chinese goods. Coming up, NVIDIA CEO Jensen Huang is urging the U.S. to ease restrictions on AI chip sales to China so he can have a bigger slice of the pie. We'll take a closer look next. This is Bloomberg.
To Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
This week, Bloomberg brings you live coverage from the Qatar Economic Forum. Bloomberg Horizons Middle East and Africa and The Pulse will be broadcasting live from the conference floor. Then, throughout the day, we'll bring you all the highlights from the key policymakers and market movers on the issues confronting the global economy. Live coverage from the 5th edition of the Qatar Economic Forum continues this week right here on Bloomberg Television. Context changes everything.
NVIDIA CEO Jensen Huang blasting U.S. restrictions on AI chip sales to China. He told reporters yesterday that the export controls have failed to stop the Chinese from developing their own advanced AI technologies. They've done so at least in part with Huawei. The U.S. restrictions have forced Chinese companies to buy chips from their own designers and caused the government to invest heavily in their own supply chain. And NVIDIA and other American chip makers may lose out on getting a bigger slice of the pie. Joining us with more is Bloomberg's Charlie Wells. Charlie, it looks like Jensen Huang is concerned that we're basically going to lose market share here in the U.S. if we allow the Chinese to continue progress.
Yeah, Matt, I mean, those are some fighting words there. And there were some of the fiercest critiques that he has made of this export control policy to date. And it's really striking. We're seeing this sort of ratcheting up of two sort of diametrically opposed ideas here, right? So on one hand, you get the follow through from this Jensen Huang idea, which is that we should remove barriers. We should allow American tech, American chips, NVIDIA chips, as you emphasize there, to proliferate around the world, right? And that would, in a sense, at least according to this strategy, prevent, say, Chinese competitors from coming up. This would require, or at least enable, a lot of developers around the world, be they in China, be they in the United States, be they in, say, Saudi Arabia, to develop on that U.S. tech stack. Now, this stands in opposition to that more protectionist policy that we hear from some corners of D.C., where the idea is just to bring about these export controls, to not allow the likes of China to use American-made chips. But of course, this Huang point is that just enables competitors.
So I guess Jensen Huang was with Trump in the Middle East. They've managed to sell a lot of chips to some of those countries with the president's help. Does he expect President Trump to then help him sell more of those chips through to China?
You know, it's kind of hard to read the kind of tea leaves within the administration because you do have some divergence here. So Huang's views align with David Sachs, the AI czar, who really has been kind of pushing that American tech stack. And I think if you look at some of these deals, some of these announcements coming out of the Middle East, it really speaks to this idea that, yes, you know, lowering barriers to trade and a lot of this AI technology, people are comfortable if it's with, you know, allies or at least countries that are not China, but that there is this real strong opposition to China. And if we just look to date to see what Wang has been able to do, he has not really been able to turn the tide on views of those export controls to China. So that is something that maybe there could be a shifting tone on. Maybe there's this view that a lot of these Gulf deals kind of help pay the way for China, but at least that has not happened yet.
Yeah, I mean, I guess, partially a concern and potentially an opportunity, depending on who you are, is the idea that he can sell large blocks of chips to these Gulf states that they then sell on to China.
That's right. And I think, you know, these, you know, harsh comments also just kind of speak to a shifting narrative that we're hearing on AI out of this Computex conference this week, which is so different from what was happening a year ago, right? Where there was this exuberance, this excitement about AI. The possibilities seemed endless. But now we're getting kind of defensive, very fierce, you know, points being made. I think an attempt to try to make sure that this American control dominates. And I think there's this idea that, you know, have people forgotten about DeepSeek? Have people forgotten, given that we've seen a lot of recovery in markets over the past few months, forgotten the enormous threat that a lot of these Chinese competitors showed earlier in this year?
All right, Charlie, thanks very much. Bloomberg's Charlie Wells reporting live from London on the NVIDIA situation. Important to keep up with one of the heaviest weights on the S&P, one of the biggest companies in the world. Coming up, a look at what else is making headlines around the world. This is Bloomberg. This is The Brief.
Bloomberg has enhanced search on the terminal to deliver.
In case you missed it, on Bloomberg Open Interest, how much would it cost to bring production here, Rebecca? I mean, what kind of upcharge would you be looking at?
There is no handbag infrastructure in America anymore besides a couple of small factories in New York City. So not only would we have to build a factory that could make the amount of units we're trying to make, but we'd have to bring back hardware manufacturing, bring back tanning and leather. I mean, these are all things that are purchased overseas and assembled. You know, if you want this to really work, give us grants to build factories, give us several years of tariff breaks in order to make these things happen, and then we'd love to make in America. It just right now, if I were to switch everything to America, my price would double, and my consumer is not here for that. As small businesses doing under $50 million, you know, keep us alive. We are employing millions of people collectively and affecting livelihoods across the U.S.
Don't miss Open Interest live weekdays.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Earnings season is here.
Earnings, the hot topic of conversation. It's going to be a lot of fireworks.
Pretty astonishing moment in time in the earnings context.
Bloomberg is first to break the numbers.
Goldman Sachs, JP Morgan, Morgan Stanley.
Booking, Airbnb.
Meta, Microsoft, Qualcomm.
There's a lot to talk about here.
With the smartest insights.
We're not seeing dramatic weakness.
It has been an incredible period of time from a trading perspective.
We feel really good about the market share trajectory.
Continuing coverage on Bloomberg. Context changes everything.
This is Bloomberg Brief. I'm Matt Miller in New York. Time now for our front page news, a look at what's making headlines around the world. First up on the Wall Street Journal, Google takes aim at AI firms challenging its search dominance. Google is overhauling its iconic search engine to compete with a wave of AI chatbots. At its developers conference yesterday, Google said it's rolling out a tab for an AI mode for users in the U.S. Next up on the New York Times, the Justice Department has opened a criminal investigation of former governor and New York City mayoral candidate Andrew Cuomo. This comes after Republicans accused him of lying to Congress about decisions he made during the pandemic. A spokesman for the Justice Department and a spokesman for the FBI both declined to comment. And on the Financial Times, the IMF's Geeta Gopinath said U.S. fiscal deficits are too large and need to be reduced over time. She also warned that the U.S. is still grappling with a very elevated trade policy uncertainty, even after recent tariff easing. The alert comes as U.S. legislators are discussing a sweeping tax cut package that will widen the deficit even further. Coming up, we speak with Lori Calvasina of RBC Capital Markets as geopolitical tensions keep the market cautious. This is Bloomberg.
much does the geopolitical volatility emanating from the United States perhaps undermine the bull case for Mexico? Is that a scenario you've plotted out?
Structurally speaking, we do still have a very positive view in Mexico. On the macro side, it is a very attractive investment geography for the U.S. Mexico is hugely competitive in terms of costs. The wages in Mexico are much more competitive than the wages in China. So why would the U.S. companies not take advantage of that?
And this structural cost advantage is going to lead Mexico to continue to contribute to the growth of U.S. as well. The value chains, the supply chains are so integrated that Mexico has to play a continuing role in the further development of the U.S. And U.S. is growing very healthily, very nicely. It will benefit Mexico this way or that way. It will benefit Mexico.
Mexico for BBVA is, a source of resiliency of earnings, and it generates and complements the diversification that we have from the footprint. But there's another topic that is very important, which sometimes we don't focus a lot about, and why we're so convinced that Mexico is going to continue to do well, which is the leverage in the country. Because the leverage in the country is only 33%. And when you've seen Mexico grow and BBVA grow in Mexico, structurally speaking, the leverage is so low that just a little bit of growth in the leverage is going to be able to support that bull case in Mexico. So that's why we're structurally positive in Mexico.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
From our global headquarters in New York City, welcome to Bloomberg Brief. I'm Matt Miller. Let's set your agenda. Geopolitical tensions flare up. U.S. intelligence reportedly suggesting Israel could be gearing up for a possible strike on Iranian nuclear facilities. And a criticism from NVIDIA. The CEO, Jensen Huang, blasting U.S. chip curbs on China, calling it a failure to hold the country back from its own progress. And we continue our coverage of the Qatar Economic Forum with the CEO of the Ashmore Group, Mark Coombs, in this program. Now, Morgan Stanley has raised its call on U.S. stocks and treasuries. The S&P 500 index will reach 6,500 by the second quarter of 2026. Now, that sounds pretty high, but it is actually below consensus. Joining us now is Lori Calvasina, head of U.S. equity strategy at RBC Capital Markets. Lori, thanks so much for joining us this early on set. To me, it sounds high because of the shock that we went through after April 2nd, the big drawdown. I know we've bounced back up almost 20% now from the lows, but can we go another 600 points from here?
So look, I think it's all about time, and frankly, I think it's also about the macro, and I think we've got a lot of uncertainty in that macro backdrop right now, but I will give you a sense of the numbers. I haven't changed my target for this year. We're still at 55.50, and we have not done one for 2026. I just want to make that clear. But the other day, I did update my earnings model and my valuation model. My earnings model, I only do for 2025. I've got it 258. Next year, I'm kind of like looking at the consensus numbers, which are 299, and then also kind of haircutting that by around 9%, which is your typical downward revision from this point in time. So it gets you closer to like 270-ish. I forget the exact number. So if you take all those numbers and then you look at multiples, I updated my valuation model for our economists' views of this year and next year, and I'm going to spare you all the details on the math, but when I run through that against those earnings numbers, I get to 57.30 for the end of this year, and next year I can get you up to 68. Now, that's on the more
for the end of
26. For the end of 2026. Yeah. Now, if I take now that 6,800 is if I take the more favorable 299 EPS. Right. If I take the haircut one, I get something a bit lower, and I think the range is like 6,200 to 6,800. So, and you could drive a truck through that, right? But it is too early. But I would just say that 6,500 number, right, is kind of smack dab in the middle of that range. So it's not totally crazy.
Right. From an earnings standpoint, I get that you could have that optimistic view. Yeah. How do interest rates affect those numbers? Because right now there's, I think, a little bit of a mini freak out going, right? We've got the 20 and the 30-year above 5%, the 10-year at 4.5%. And this Republican Congress aims to broaden out the deficit. They want to increase the debt substantially, and that causes concerns among foreign investors.
So I would say, you know, sort of four ways you can look at it. So let's just take that last point you mentioned, the concerns of foreign investors. That was something people were really focused on, let's call it like 2 months, 6 weeks ago. And it felt like that was dying down. And I think what this Moody's downgrade has done, you know, my rates team would tell you, you know, there's nothing mechanical here, right? They feel like maybe the concerns are overblown a little bit. But at the same time, it's giving the people who were making the Sell America trade on the deficit concerns, it's just bringing that issue right back to the surface. So that's one thing. If you put that aside and look at interest rates more discreetly, there are a couple ways you can think about it. One, our cross-asset model, earnings yield gap analysis. That math gets problematic for the stock market if you hit 5.3% on 10-year Treasury yields. But what we've seen the last few years is the market starts to really get worried and act out on those worries when you start to make that approach to 5%. So that would be sort of your second issue. 4.5 is okay. Getting close to 5, not so okay. The other ways you'd think about it, I would say one.
And that has what effect on earnings?
In terms of the earnings yield gap model, it doesn't impact earnings per se. It's just more perception of what asset class you want to be in.
Okay.
I was actually going to get to the earnings one next, which is just if you think about interest expense and pushing that up, that's where the 10-year yield really matters on sort of my earnings analysis. You know, you bring it up, right? You bring Fed expectations up. You're gonna increase your interest expense, right? And I've had some pretty favorable interest expense baked into my earnings outlook. The last way is just purely thinking about valuation multiples. Push the 10-year Treasury yield up, push the PE multiple on the S&P down. I will tell you, though, inflation matters a little bit more than interest rates for that last calculation. We've done a model, and I know there's going to be someone writing me some hate mail or use some hate email on that, but we actually have modeled this out back to 1962, and while you do care about interest rates, the inflation environment, I think, matters a little bit more in here.
Okay, so this same group at Morgan Stanley, I think Serena Tang is the global head of cross-asset research, and it's her team that has done this. They expect rates to come down on the 10-year to 3.45% by the end of this year because of 2026 Fed rate cuts priced in.
Yeah.
So does your inflation model allow the Fed to continue cutting at this level?
So the RBC House views, that's actually what I baked into our valuation refresh that we put out on Monday. And Blake Gwynn is our rate strategist. He's fantastic, by the way, and he will get up early. But you know, he'd be better at walking through this than me, but he's basically got, I think, 3.8 at the end of the year, and they've got 3 Fed cuts. And they've said the cuts start in September. They do think the Fed call is very tricky. But they do, you know, I think as a house, you know, RBC macro, we're concerned. We're not looking for a recession. We are still looking, you know, for sort of, you know, slightly weaker GDP growth. I think our full year number comes out to 1.2%. Our economist was saying, you know, think of it as like 0.5% to 1% if you're thinking about those quarterly numbers. So we kind of have this idea that, you know, we're not going to have a recession, but we are going to have to pay some economic costs, right? There's some economic damage that's going to be incurred from everything that we just went through and everything that's coming from the tariffs. So it's a tricky spot. But we do, you know, as a house, expect those cuts to come back in. And Blake does have, you know, 10-year yields moving up and then 10-year yields moving down again. And that filters through into my earnings model. The interest expense number does end up being favorable. So if we dial down those cuts, if we see interest rates creep up, it is going to be a headwind for my earnings number.
I have Blake's bio page here on my screen. It's got his number and his email, so I'll get him on the show for sure. Bottom line, you're looking at still lower S&P level than here for year-end 2025. I imagine you expect some growth for 2026. What do you tell the average investor out there, retail, who has money every month to invest? Continue to stay invested in U.S. stocks?
You know, it's funny. There's been this whole narrative out there about like, oh, the retailer has been buying the dip. And I tell you, I watch the EPFR data every week, and I don't see any big surge in flows. So I don't know what people are talking about there. I do know that anecdotally, when I talk to people in the advisor community, some people are buying the dip and other people are not. So, you know, I do think maybe the headlines out there have gotten a little bit ahead of the reality of the data on the ground. But look, I think as stock investors, right, and I do equities. We do kind of 6 to 12 month time horizons on our targets. When we think longer term, we know that these periods of turmoil end up being buying opportunities. We don't know exactly, sort of how quickly you get back to past highs and when you exit the period of chop. And I am increasingly coming around to the view that we're in an extended period of chop, that this is not off to the races. And if you think about, that move that we've had since April, we've really recovered a lot of that loss. And to be clear, in April, our view was that we were going to have a growth scare, that we were not going to price in a recession, which is where you would have gone to like 4,500 on the S&P. We thought the risks there were rising, but we really thought this was going to turn out to be a growth scare with like a 20%-ish type drawdown. And that's basically what we got, 18.9%. We've rallied hard off the bottom. That is typically what you do. But this
also about 18.9%,
yeah,
right?
Yeah, and if you look at like, again, that valuation modeling for 5730, that's baking in a better view of GDP than what we had pre-Liberation Day. Like it's baking in, kind of, or post-Liberation Day rather, it's baking in the idea that maybe we got a little too pessimistic around Liberation Day and we're, anticipating things being a little bit better, but still not things being back to where they were in January. And I'll tell you, Matt, last week, after the kind of China, U.S. pivot, I got a lot of questions about, well, why aren't you just slapping, the target you had back in January, just put the 6,600 back on? And I said, we're not back there. Like, I was never sort of looking for a disaster here, but the idea that like we've just sort of erased everything we've been through just doesn't make sense.
Right. Well, I mean, even if tariffs are taken down, they're still relatively high, 10% baseline, 30% on China. And you could argue also that some economic damage has been done.
Yeah, and I think we see that in the sentiment data. And look, it's so fascinating. If you look back at this reporting season, there's two views of the consumer out there. You look at the credit card companies, you look at the banks, you look at any of these like processing companies that take like a higher level look at the data, and they're like, oh, the consumer is still fine, they're still spending, the numbers are up year over year, yada, yada, yada. And then you go talk to the consumer companies, and they're like, yeah, they're still spending, but guess what? The high end is trading down. They're going to the discount retailers, right? You're hearing the companies that make snacks saying, people are not snacking as much. I read another company last night that was talking about the pressures on snacking. Smoking is under pressure. I mean, you see all these symbols of cautious consumer behavior underneath the surface. They're not exactly battening down the hatches, but they're getting ready for something, and that something isn't good. And so, the idea that we're just right back where we were in January, where there was all this optimism, that's just not realistic.
All right, Lori, great having you in here. Really appreciate your time this morning. Lori Calvasina is the head of U.S. equity strategy at RBC Capital Markets. Let's get to our other top stories trending on the Bloomberg terminal this morning. UK inflation jumped more than forecast to 3.5%. That's the highest rate for the UK in over a year, and the jump prompted investors to reduce bets on interest rate cuts from the Bank of England. They still expect one, but the pound has risen to its strongest level since February of 2022. Julius Baer disclosed it is taking a loan loss charge of $156 million related to its private debt business and selected positions in its mortgage operations. The CEO of the Swiss private bank said it's not expected to uncover additional risks that could lead to further losses. The review of its credit portfolio, though, is still ongoing. And the U.S. has removed the de minimis exemption to cheap goods out of China. Other countries are considering similar moves at a meeting of G7 finance chiefs in Banff in Canada next month. The Canadian finance minister spoke at a news conference about the discussions.
We started that discussion, but certainly the low-value shipments have created a number of things that we want to discuss amongst ourselves and see how we can progress that discussions, because it's not only about the revenues, but it's really about, the customs and making sure that we protect our respective jurisdiction, that these packages are not used to smuggle things in different jurisdictions.
So other countries could raise tariffs on cheap Chinese goods. Coming up, we head for day 2 to Doha of the Qatar Economic Forum. We speak with the CEO of the Ashmore Group, Mark Coombs. Next, this is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
In case you missed it on Balance of Power.
If we're going to get all this revenue from tariffs, why would the president be pushing for higher taxes on anybody? Because our understanding is for the wealthy, he's looking at a new rate of 39.6%, and I thought the Republican Party didn't stand for that kind of thing.
Well, you realize that the tariff revenues doesn't count toward the reconciliation numbers. Don't ask why. I can't understand why. We're running at like 20, 25 billion a month, and they're not counting it, but we'll leave that aside for another day. This is Washington. They have their own accounting practices. So the president's trying to make sure he gets no tax on tips, no tax on overtime, and no tax on Social Security. And if he says, look, the richest Americans, remember, he cut it from 39.6 to 37. So if he just goes back to what he did last time, you know, I'm in favor of that. I think it's smart.
Don't miss Balance of Power live every weekday.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
This is Bloomberg Brief. I'm Matt Miller in New York for Danny Berger. Let's head over to Doha right now, where Bloomberg's Francine Lacroix is live from the Qatar Economic Forum in Doha. Francine?
Matt, good morning. I'm so happy to speak to you here. Look, we're 2 hours ahead from London, so that's many hours ahead of New York, and we're in full swing, and I am delighted to be joined by Mark Coombs. Mark, thank you for joining us. Look, we talk about the markets, we talk about growth. We've had some great panels trying to figure out what happens next. We've seen Sell America. Does that continue?
Yeah, well, perhaps. Thank you very much for having me, first of all, Francine. Delighted to be here. Sell America. I think some people are probably not so much selling America as maybe not adding as much to America as they got in the habit of doing. So at the margin, buying America is probably less of a momentum trade than it was for the last 2 or 3 years.
But where do you see that changing? I mean, is there a worry that actually some of the policies that hurt the rest of the world really start hurting also America? And can other countries, including emerging markets that you've been following very closely, benefit?
I think the fear is just coming from looking at the sheer dominance of America in terms of the global indices. I mean, if you look at the ACWI, it's 66% of that, with an economy that's probably 20%. There's just a huge concentration of risk and capital there. What we're seeing is people gradually saying, oh, that was a bit of a reset. What's gone on over the last 3 to 6 months? Maybe America isn't riskless. And in terms of what we do, we invest in emerging markets, and every 5 years, we're reinventing the wheel and saying to people, remember, home country bias in the U.S. can be a dangerous thing. Think of diversifying. So I would say from Asia, from Europe, there's definitely a bit of interest in diversifying. U.S. is still fairly concentrated in the U.S. and from the institutional clients that we're talking to.
Mark, I mean, we're looking at the numbers. We love crunching numbers at Bloomberg, so I'm sure it's no surprise to you. So we've seen outflows from emerging markets over the last 3 years come to around $200 billion. I mean, does that reverse with some of the policy and volatility that we've seen? Is money being put back into emerging markets?
We're seeing the beginnings of it in certain spaces. So I think like a lot of things in life, people like certainty, and while they're seeing uncertainty from the US and in terms of not sure what's going on with inflation and growth, people are probably doing little. Uncertainty, people tend to sit on their hands and stare at the wall and go, oh dear. We're seeing a little bit of interest, certainly in the investment grade bond space and within emerging market equities and things that last for the long term. So the key things are healthcare, education, infrastructure, long dated closed end assets. We're seeing some interest in that, because the larger EM economies are going to see a lot of growth and a much higher growth rate than DM. So that story is continuing. But the marginal investor, I would say, is beginning to say, well, where do I go now? Well, wait a minute, is AI just a US story, or is it a Chinese story too? And the Chinese market was so heavily oversold. So I'd say in the bond space, investment grade, we've seen institutional investors, certainly from Asia and Europe, already beginning to diversify and looking at EM. In the equity space, recently there's been a bit of a kick that way.
But are there specific emerging markets that you'd want to be invested in right now? Again, I mean, this is structural. It could also be linked to supply chains and how close or not you are to China that you get slammed.
Yeah, and whether your Chinese goods get routed through you
right.
or not.
Or not.
Yeah,
so
and if people spot it or not and want to make it enough of an issue. Yeah, there are markets we like. I mean, it depends on different things for different assets. I mean, obviously, the larger economies that are strategically important, we think will benefit from a whole series of flows. Strategic, reshoring, nearshoring, natural growth in their own economies. So the bigger ones that can fuel their own growth, we like a lot.
But have you definitely seen flows change this year or since Liberation Day?
A little bit. It's only quite recent.
What's a little bit? Like,
well, because institutions take more than a month to make their minds up. But in terms of retail space, yes, we've seen a little bit of interest. Certainly in the equity space, we've seen a little bit of pickup in investing in EM equity, particularly because I think a lot of people are saying, well, hang on, China was so cheap. And if AI is not just a US story, and seems like there may be an AI story in China, we're seeing a little bit of interest in the equities from retail. Retail you tend to see first.
And you see that, staying, the fact that actually people tend to like equities over fixed income in some of these emerging markets?
Different strokes for different folks. So the rapid trader, the retail investor tends to go straight into equity. Some of the US, for example, is primarily an equity market. When they come back, they'll probably come back to equity first over fixed income. Elsewhere, I mean, the Europeans, certainly the big insurers, the really big pension funds, they like to have a big fixed income allocation. So it's different strokes for different folks.
Your best conviction, actually, for emerging markets,
for
and
an equity
why?
return or a bond return or an alternative return?
Both.
My best single country or... Wow, actually putting me on the spot.
What am I giving you? 2 million. You want 2 million? And like the highest where'd you put the 2 million right
2 billion or 2 million?
2 million.
I like you less than if it was 2 billion. Come on, lady, give me 2 billion. I think it depends what you're trying to do. I mean, I think best near-term opportunity is probably things that have been sold the heaviest, that are fundamentally quite large economies. We think there is an opportunity actually in China around that tech space. We think there's obviously an opportunity in India. India has this terrible habit of getting overbought by retail and getting a bit volatile, but we like India, we always have. We think there's scale there. And we think Southeast Asia, there's stuff going on. We like Indonesia, we like things around that space. Within Latin America, I think Mexico is a keep. A lot structurally going on in Mexico that's interesting.
Right. I mean, you mentioned alternatives. I mean, what do you do with private credit at the moment, or even private equity in some of the emerging markets?
So private equity, we tend to try and follow three main themes. The things that we think the larger economies really need to develop and help them going forward: healthcare, education, and infrastructure. And what we're trying to do there is structure long-dated money to go with what they're trying to do, which is create growth. But also they're normally trying to build their own domestic pension system, and those systems need long-dated assets. So we like to do that both in the debt space and the equity space. So some of the most interesting things we're doing is 25-year development capital for road systems, airports, power. So we like all of that. We're less, I mean, there is a consumer story, there is obviously a retail story, but that's less our thing. We're more into the sort of the boring bits that go for a really long time.
Okay, what looks expensive at the moment?
The US.
In emerging markets.
The US, just kidding. Everyone, in the end, everything's an emerging market. The only difference is emerging markets, the price is normally set for it. One looks expensive.
You know what? I've heard of stories in trading floors where emerging market, actually, traders that used to deal in emerging market in the 90s were very good at trading equities in the US over the last couple of weeks because it's a real advantage knowing how to trade it.
Yeah, distress is distress. So, yeah, you certainly need to be thinking, especially when you get political issues. So you're asking what's the most expensive in EM?
Yeah. Is there something that it's just not the right time to, that you're either selling off? Give me two enemies.
I won't make any enemies. People understand. I think things occasionally rally a bit quickly. Sometimes you get a very sharp rally. There was a bit of a relief rally around the Romanian election. So that was a bit of a knee-jerk relief rally, and that's settled a bit. I think that's probably fine. They have a lot of things to sort out. Long term, we think as long as they do sort it out, it'll be fine. Otherwise, EM is actually relatively cheap, especially against the US. I mean, come on. It's
I see one enemy. No, I'm kidding. Thank you so much.
Hopefully not.
For joining us, Mark
Pleasure.
Coombs.
Thank you for your time.
A fun interview there with the Ashmore Group Chief Executive Officer. Matt, with that, I'm going to send it back to you in New York, and we'll have plenty more from the Qatar Doha.
That was a lot of fun. I appreciate it. Francine Lacroix there in Doha, the anchor of Bloomberg's The Pulse, speaking with Ashmore Group CEO Mark Coombs. He's the boss of our buddy Gus. Coming up, we're going to get you set up for your trading day with earnings and a bond auction at a time when the Treasury market is being watched very closely. This is Bloomberg. This is The Brief.
Or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne-Marie Hordern in Buenos Aires, Argentina, and this is Bloomberg.
This is Bloomberg Brief. I'm Matt Miller in New York for Danny Berger. Let's get a look at what's ahead today. More retail earnings with Target, Lowe's, and TJ Maxx reporting before the bell. Plus, President Trump hosts South African President Ramaphosa at 11:30 a.m. Eastern. And tune in for an exclusive interview with the Speaker of the House, Mike Johnson. He'll be on with Bloomberg surveillance co-anchor Anne-Marie Hordern. That's at 9:25 a.m. New York time. That's it for Bloomberg Brief. Surveillance is up ahead. This is Bloomberg.
see over the next 3, 6, 9 months how the tariff discussions play out and what does it mean.
I do factor in some effects of tariffs now on inflation, on prices.
I like the idea of the 10% tariff across the board.
I've spent my entire career focused on fiscal discipline. I don't think these people have the foggiest notion what they're doing. And I think DOGE is doing tremendous damage to government.
Elon Musk is probably the inventor of our age, but who understands that we're in the midst of the most profound convergence among technologies.
When we are facing a once-in-a-generation technological disruption,
we cannot close this retirement gap without private-public partnership. We have to have good policy.
Do you think, Dawn, that the market is correct to be, as of now, pricing in 3 rate cuts in 2025?
I would take the other side of that bet.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
The fiscal situation is a real mess. The spending is out of control.
Direction of travel when it comes to the fiscal discussion is only one way, namely that we will see debt levels go up.
I think the bond vigilantes are weak.
The bond vigilantes have to get the attention of the politicians.
The turbulence may go on for years and years, by the way, but we first have to see how the fiscal drama plays out in Washington.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Wednesday as a tax bill fight brews in Washington.
Are Republicans still grandstanding in your view?
Oh, yeah, sure. You have a couple who will grandstand, but I think even the grandstanders should. Look, the alternative is a 68% tax increase. You can blame the Democrats for that and 1 or 2 grandstanders. So this is the biggest tax cut in the history of our country. Or you'll get a 68% tax increase. And if that happens, I mean, what Republican could vote for that to happen? Because there wouldn't be a Republican much longer. They would be knocked out so fast.
The president grown frustrated with demands on Capitol Hill, urging Republicans from high-tax states not to derail his tax bill. Lawmakers from New York, New Jersey, and California digging in, but Speaker Johnson is sticking with his Memorial Day deadline.
As a reminder, we're right on schedule. Our House budget resolution gave instructions to 11 separate committees in the House to write their portions of the budget reconciliation bill, and they did it right on target. We never thought this was going to be an effortless process, because when you're doing this much in a bill this large and complicated and comprehensive, there's a lot of opinions in the room.
That deadline is just days away.
And it is the concentration of this market, and it is remarkable to the extent that it is. You can even get reports overnight that Israel is considering striking in Iran. And what happens, John? It is a flea away from duration. It is that considerate concern that there's going to be a growing U.S. deficit that is mounting, growth is slowing, so it makes Treasuries to look more difficult as a haven as D.C. really tries to figure this out.
Check out the long end of the curve this morning. We're up by 5 basis points and back through 5% on a 30-year maturity. The 30 yield this morning of 5.02%. A question we keep returning to on Bloomberg Surveillance. What is going to constrain this tax bill down in Washington? The fiscal hogs or this bond market?
The thing about this bond market, though, is this has been a very orderly sell-off. This is not something that many people have called for what you need, which is, I'm sure she doesn't like this, but a Liz Truss moment. Instead, it is a slow creep higher in 30-year yields, and it seems to imply that this repricing could be more sustainable and more durable than what we saw in April, and less reactive to D.C. because it is a slow inch higher.
It's fair to say that Liz Truss hates it. Yields are up. Equities are down. Equity futures on the S&P negative by 0.8%. Coming up this hour, we'll catch up with Peter Cheer of Academy Securities as stocks snap a 6-day winning streak. Sucharita Gedalia Forrester reacting to earnings from Target. And Dan Ives of Wedbush on Elon Musk's recommitment to Tesla. We begin this hour with our top story. House Republicans looking to strike a tax deal on Capitol Hill. Joining us now, the Bloomberg team, Anne-Marie and Tyler Kendall. AMH, first of all to you. You're catching up with Speaker Johnson later on this morning. How high are the hurdles to get this done next Monday?
It's a really big day for Speaker Johnson because we should note the amendments that he agreed upon all day long and all evening long into the early hours are still being discussed in the Rules Committee. So these amendments, this bill is making its way through the Rules Committee right now. It started at 1 o'clock in the morning, and we don't even have the text yet to confirm what was discussed. So this is a really important day for Speaker Johnson. First question, can it get through the Rules Committee? And then, of course, how soon could he get it on the House floor to meet his self-imposed Memorial Day deadline? We will see what he has to say in the 9 o'clock hour when he sits down with me here in Washington, D.C. But, Jonathan, two big changes per reports were discussed, and this is potentially able to get the entire Republican conference together to vote for this. One is the SALT cap. This is really important for high-tax states like California, New Jersey, and New York. You've heard that before. I know you've spoken a lot with Representative Mike Lawler. So what was agreed upon was lifting of the SALT cap from $10,000K to $40,000K for those making less than $500,000. Now, there's also something else in there potentially for conservatives. We do expect potentially the carve out, the rescission of these credits for green technology, those grants, that might happen sooner than it was expected to be. So maybe as soon as 2028. So that would be a carrot for those conservatives to be able to sign up for this. But we should note this is going to be a long slog today on whether or not this bill gets to the House floor.
Tyler, the president went to Capitol Hill to rally the troops to herd the cats. What went wrong?
Yeah, hey, John, good morning. Well, President Trump did come with this message trying to pressure these lawmakers to reach a deal. But at the end of the day, afterwards, many said that they weren't going to budge unless they saw some changes to how the deal stands. Now, it's our understanding that President Trump singled out those two factions that Anne-Marie is talking about, those so-called SALT Republicans and also those fiscal hawks. In fact, I had the chance to catch up with one of them, Congressman Mike Lawler, a Republican from New York, who told me that he made his case directly to President Trump that so far the proposals had been inadequate. I spoke to many Republicans as they were coming out of the meeting, and the message seemed to be stop messing around. That was a direct quote from Dusty Johnson, one of the Republicans that is trying to urge them to come together on a deal. At this point, we're really going to have to see if these changes that Anne-Marie was outlining is going to be enough to get this over the finish line. Because, John, after President Trump left Capitol Hill yesterday, Speaker Johnson made his way over to the Senate, considered to be an unusual move, but it is clear that he is working with this administration to try to grease the skids that once it gets through the House, and when it gets through the House, they're going to also face an uphill battle when it comes to the upper chamber.
Tyler, Anne-Marie, thank you. The negotiations continue down in Washington, D.C. Here's the view from Wall Street this morning. Peter Chi of Academy Securities writing, Budget 2026 will be a crucial stepping stone. It may not be smooth sailing. There's potential for friction domestically that may impact markets negatively from here. Pete joins us now for more. Pete, good morning. Good to see you.
Good morning.
Is Congress picking a fight with this bond market?
I think Congress is trying to do the right thing and get this budget passed. I think, unfortunately, DOGE wasn't quite as successful as we thought, so the deficit's going to go up, but I think they have to power through this. But there is this immense amount of friction. I go back to the University of Michigan surveys where you've never seen such discrepancies between what Republicans think about the economy and what Democrats think about the economy. So it's going to be a struggle to get this through. Hopefully they get something through that's reasonable and that we can move on with. That was kind of, I think, what Trump was brought in to do, is growth. This kind of is the first thing that we've seen that's truly growth for a while, so let's get this through.
Do you think it's good or bad if we do get it through? For markets, thinking across stocks and bonds.
I think it's probably not great for bonds. I think we could see a little bit higher yield. But from there, I think it's probably fine for stocks, right? This is the first stepping stone. And part of it, it's a disaster if we don't get anything through, right? Because the big problem, I think, with this is it's extension of existing tax cuts. So if those disappear in some way, shape, or form, that's just awful because no one's behaving as though they're coming off. So a lot of this deficit's going to be increased, but it's not going to get the full bulk of it coming into the market because it's only the incremental increases, I think, that will create new spending power.
Why is it good for stocks when the first time around, when we had a similar debate in Trump 1.0, when you had tax cuts that were supposed to juice the markets, you got 10-year yields to 3.25%. That was enough to spook equity markets. We're at 4.45% now. Why isn't that enough to spook equity markets?
Well, I think last time we ran up heavily right into the actual tax bill getting passed, so there was a lot of sell the news. I don't think we've had quite that same run up. I think we've had the run up much more because of tariffs. But again, we've had, I think in the last 2 weeks, we've been talking a lot. The Trump put is clearly back on the table, and Trump pivot has been very helpful to markets. So there is some risk if yields go higher. My biggest concern on the yield side is the basis trade, which supposedly was a big part of why yields went higher back in April. That got reset. I think one of the problems whenever we get sort of intervention is those trades get reset and people get very comfortable. Hey, if they're going to intervene, I can put this trade back on. So the stops will be higher. But I'm concerned if you start getting to 5.10, 5.15 on 30 years, it can accelerate quickly because that basis trade unwinds again.
So to be clear, is there some real market fragility you're worried about at this moment?
Yeah, I'm not in panic mode, but I do think bond yields could push higher. So I think structurally we should be lower. I think right now the technicals are pushing for higher yields.
Structurally we should be lower. What do you mean by that?
That I think when you look at the state of the economy, it's not doing great. It's okay, but I think the backing off of tariffs actually gives Powell some ammunition to cut rates if he chooses to later this year. I think the employment data has been a little bit goosed in how it's calculated with the birth-death model. You're not seeing that through a lot of other statistics. So, and inflation as a whole, away from what's going on with tariffs, had been coming under control. So I think we should be more at 4.25 on 10s, but I think that's at the bottom end of my range because of the technical.
Just to follow up, isn't that the concern, that there are economic reasons for yields to be lower, but they're not? Isn't that the problem here? And isn't that raising a question about what is happening and whether there is a buyer's strike starting to develop?
I do think you go through these ebbs and flows, right? So everyone got very bullish 10s. Oh, this is going down. Everyone believed in investment. Hey, we can get to 3% on 10s. So the positioning's bad. I think that's pushing. And the Moody's thing, I think it just really triggered everyone's reminder. Hey, this deficit's real. We're not accomplishing what we thought. And globally though, there's a buyer strike. That's the interesting thing to me, right? It's not just U.S. yields are going higher. Across the globe right now, you're seeing yields go higher.
Well, that's the question, though. If not the U.S., where do you go? Where do you go? You can't buy Japanese duration right now after horrible auctions and continued pressure there. So where would you go if not the U.S.?
So I think you want to be at the shorter end of the curve right now because there's so much uncertainty what's going on. I do think you have these risks, these basis trades unwinding. Japan's no longer the cheap, the carry trade could be at some risk. I do think the one thing you're seeing is investors in each country moving a little bit more towards their own currency. So if you're in Japan now, you buy yen bonds. If you're in Europe, you either buy bunds or something else. So I think treasuries are going to be most affected by a demand for local debt, moving away from the dollars, not jumping through all these hoops. Because again, you look at 10-year in Japan, 1.5%. It's been a long, long time since anyone in Japan could get any sort of yield without having to jump through all sorts of hoops, buy dollars, bonds, and swap them out. So I think that you kind of have the separation.
I'm calling this the great repatriation. We'll see if it catches on. What I'm trying to figure out is whether it's the consequence of pull dynamics or push dynamics. Which force is dominating here? Better policies elsewhere, or is it policies in the US pushing capital out?
So I'm kind of looking at it three different ways. So on the treasury market or the risk-free, I think people are kind of pulling back to their own markets. I think in credit, that's going to be very limited ability to do that, right? If you want to be a diversified credit portfolio, you need to buy U.S. credit because, one, we have many more sectors. You've got much more, in terms of rating, breadth and maturity breadth. So I think U.S. credit's going to be better protected than the treasuries. And I think U.S. equities are really going to be fairly well protected, partly because, it's kind of a misnomer to call it U.S. equities, right? 40% of the earnings are, the S&P 500 is full of giant global companies. So I don't think people can pull out as U.S. equities as much, just because they really aren't U.S. equities. I think the Russell 2000 maybe people could avoid. You're going to be in the NASDAQ 100. You're going to be in the S&P 500 if you're even a foreign investor, because these are big global companies. You need exposure to them.
Pete, this is great. You're going to stick with us. Peter Cheer there of Academy. Equities down this morning by 0.8% on the S&P. Bond yields higher at 5 basis points at the long end. Your 30-year yield this morning at 5.02%. With an update on stories elsewhere this morning with your Bloomberg Brief, let's cross over to Yahara Anand. Hey, Yahara.
Hi, John. House lawmakers are debating President Donald Trump's tax bill through the night. The hearing started at 1 a.m. Eastern. Key points of contention include expanding the SALT deduction and curbing spending on Medicaid benefits, plus clean energy credits. Lawmakers hope to meet a self-imposed deadline to approve the legislation by tomorrow. Meanwhile, President Trump says a missile defense shield called Golden Dome will be operational by the end of his term. He says it may cost $175 billion, but the Congressional Budget Office says the bill could reach $542 billion over 20 years. Trump has appointed a Space Force general to oversee development and says Canada also wants to be part of the program. Meanwhile, UK inflation accelerated more than expected to 3.5% last month, its highest rate in more than a year. The increase was driven by increases in energy, water, and other administered prices. Traders slashed bets on further interest rate cuts, favoring just one more quarter-point reduction by the end of the year. That's Bloomberg Brief. John?
Yahara, thank you. More from Yahara later this hour. Up next on the program, pressure building in Washington.
So this is the biggest tax cut in the history of our country. We're not doing any cutting of anything meaningful. The only thing we're cutting is waste, fraud, and abuse.
Up next on the program, we'll head down to the nation's capital and catch up with Terry Haynes of Pangea Policy, live from New York City this morning. Good morning.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Snapping a six-day winning run on the S&P 500 this morning, negative, down just a little bit softer. We're off by, let's call it 0.8% on the S&P. On the Nasdaq, down by 0.9. Check out the bond market. Yields up again. Hello, 5%. Hello again. Your 30-year yield up by 5 basis points, 5.02% on a 30-year. Under surveillance this morning, pressure building in Washington.
So this is the biggest tax cut in the history of our country, or you'll get a 68% tax increase. And if that happens, I mean, what Republican could vote for that to happen? Because there wouldn't be a Republican much longer. They would be knocked out so fast. We're not doing any cutting of anything meaningful. The only thing we're cutting is waste, fraud, and abuse. I'm a cheerleader for this party, and I'm a cheerleader for the country. Much more importantly for the country.
So here's the latest this morning. A key House committee convening on President Trump's tax bill after his trip to Capitol Hill failed to convince some Republican holdouts. Anne-Marie has the latest from Washington. Hey, Anne-Marie.
Well, Jonathan, lawmakers on Capitol Hill have been working through the night through this Rules Committee, this hearing. The first panel of this hearing wrapped up at 4:30 in the morning. So you can just expect how long this may drag out. It's going to be a slog. But we do know behind the scenes there were some deals cut. And for some more insight on that, we want to bring in Terry Haynes of Pangea Policy. Terry, you've seen the reporting, I'm sure, and I'm sure you have a little bit more insight. What do you make of the deal cut when it comes to salt, as well as pulling back some of those clean energy investments? Is that going to be enough to satisfy some of the naysayers?
Good morning, and I think it probably is. Yeah, the salt deduction, of course, has been talked about quite a bit, so I won't reiterate. But it sounds like that deal is going to be enough. And as you pointed out earlier, we haven't seen it papered yet, so that may take a little bit of time. And the green energy phase outs also are things that Republicans have been interested in for quite some time, and so I imagine the combination of that is going to be enough. But Johnson will use the Memorial Day recess, kind of as a hard backstop. This is kind of standard procedure on the Hill and in the House, particularly a hard backstop to get people to put up or shut up. And I expect he'll have enough votes at the end of the day.
Of course, Congress needs a deadline in order to really get something done, Terry. But even if Johnson is able to get this through the House floor, give our audience a sense of how difficult this is going to be when this bill goes to the Senate. Does it even look recognizable when it comes back to the House?
Well, it's going to look different than the House, certainly. Speaker Johnson went to the Senate yesterday and begged them to keep it as close to the House version as possible, and I'm sure that fell on deaf ears. The thing you got to understand is that the Senate the House is a kind of a very majoritarian sort of body. The Senate is much more collaborative. Think of these folks, since they only need Republican votes. Think of them as 53 CEOs all negotiating with each other, and that's what you're going to get. You're going to see a very different Senate bill. It's going to take weeks, and at the end of that process, I think what you see is, in Capitol Hill parlance, you see the Senate trying to jam the House. In other words, the Senate will do its bill, say take it or leave it, and then what's going to happen is the House is going to have to be herded again in order to make this happen, more on the Senate's terms than the House. That's really where Trump comes in right at the end.
So what happens on the Senate terms when it comes to SALT, Medicaid, and the clean energy tax cuts?
I imagine that SALT will still be fairly generous. I imagine Medicaid gets softened at the edges. They're hardening up work requirements and some other things in order to get House conservative votes on Medicaid. I imagine that gets softened again. And on green energy, I imagine again it probably gets extended a little bit. The net effect of all three of those, frankly, are things that are politically more palatable, but may have the effect of nudging around the debt and deficit problem even further.
And you think this can get done by July 4th? How?
I think it's certainly possible. Firstly, you need a political imperative, which is a fancy way of saying that you need Trump, the executive branch, to kind of light a fire under the Senate, not let the momentum that's been built up by the House dissipate. Secondly, you need that to happen in the Senate leadership as well, and I think it probably does. Thirdly, now that the Senate's got a template from which to work, what you will see senators of all stripes on the Republican side, the only side that matters in this unique process, coming out and actually, giving their own red lines. So you begin to assemble a coalition of 53 Republican senators, not unlike the herding that you've seen in the House.
Terry, if this doesn't get done, what kind of tax increases could we see going into next year?
Well, if it doesn't get done, then you've got your bumper. You had Trump on the bumper there saying you're going to have essentially a snapback to pre-17 tax law. So that's for people that are used to the current situation, that's a huge increase. I have 68% in my head because that's what the president said. It may not be exactly that, but it'd be something fairly large. So, the kind of the looming economic undertow here is worth remembering as well, and that creates its own sort of urgency. The other thing about the July 4th deadline that I want to mention is there basically three kinds of things coming together. It's not just the tax bill, it's also that reciprocal tariffs are being studied, and there will be a report out on that. And I would look at that as a deadline for a lot of these trade deals that are being negotiated as well. So you have the opportunity to either have a substantial lift coming out of Washington economically, or or substantial downturn, either way, frankly, politically.
Terry, the bond market this morning on the long end, we do see yields once again higher. You know, interest on the debt is currently the fastest growing part of the U.S. budget. If they get this deal done, how are they going to deal with the deficit after this?
Well, they're not going to deal with it in this bill, as you know, and there's an expectation by some who don't understand the process, and people shouldn't necessarily, but that this bill will wrap up all problems, and that'll be the end of it, and that's not the case. I think what you'll hear going forward is a lot more from Secretary Bessent about his 3-3-3 idea, the idea that now what we're going to do is we've dealt with the taxes, we've dealt with manufacturing, we're dealing with trade in a separate track. Now we're going to turn our attention to spending discipline. So what you're going to see in the first instance, I think, is you're going to see huge fights, months-long fights, frankly, over spending in the fall, not just because Republicans want to show some fiscal discipline, but because Democrats also want to resist a lot of the things that Republicans want to prioritize on spending discipline. And they look at that opportunity for spending in the fall as a means of revivifying their brand, frankly, which is not in a good place.
Terry, thanks so much for your insight this morning. Jonathan, Terry Haynes there, of course, of Pangea Policy. Two things: they won't address the deficit in this bill. We know that, but maybe the fall, the bond market will start to wake up Congress a bit. And then, Jonathan, he thinks 80% chance the one big beautiful bill, which he also calls the 1-3B, gets done by July 4th.
Anne-Marie with the latest down in Washington, here in New York City. Danny Berger alongside us this morning. Peter Chair still with us as well. Pete, I want to come to you on the bond market. Yields up across the curve here. We're up by 5 basis points on a 30-year, back through 5%. Is there a level at which you believe would force corrective action in Washington? And what does corrective action actually look like?
You know, I think they're going to make sure the bond market's trading orderly, and so far it's been very orderly. I think it's very difficult for them to do anything, whether it's QE, maybe some sort of Operation Twist to try and help at the long end of the yield curve. But I think, quite frankly, we need to see the data come in that allows the Fed maybe to do something. Other than that, I think this runs its course, unfortunately.
Are we likely to see that data this summer?
I feel we are. I think in the next few months, we're going to start seeing more and more weakness in the job market. I think we're seeing a bit in retail sales. I'm more and more concerned about what you're seeing in terms of delinquencies rising. You're hearing a little bit more about buy now, pay later struggles. So I think the consumer's just about tapped out. So you're slowing there. And everyone you talk to, I think there's just so much political uncertainty that no matter what you want to do as a business, you have to act slightly conservative. So I think that hits the data until we kind of get some clarity on where we're really going to be on tariffs and things longer term, and I think we're months away from even getting a glimpse of that.
September is what the Federal Reserve, Danny, told us earlier this week. Wait until September.
Yeah, but how distorted is the data going to be in the meantime? As everybody rushes to get shipping in, who's to say even in September it'll be a clear picture?
Another data point on the economy coming up. We get earnings from Target in just a moment. We'll break those earnings down with Sucharita Kodali of Forrester. Live from New York City this morning. Good morning to you all. You're watching Bloomberg TV.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with more episodes of our show, The Deal.
The theme of this season, On the Road. We're bringing you more behind-the-scenes conversations with the biggest names in sports, business, and culture, like Melody Hobson.
I started to study women's sports like an 11-year-old studies baseball statistics, and I got dangerous in seeing up arrows.
Susie Wolf.
When you're competing, you're not thinking about any fear or any worries of what could happen.
Josh Harris.
You can't do a good deal with a bad person.
Jay Batt.
At the end of the day, there's never been a better time to be a student athlete.
And more. Stay tuned.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Here's a flame for the price action for you. Equity futures lower this morning, down by 0.9% on the S&P. Similar move on the Nasdaq 100 as well. Earnings from Target dropping any moment from now. Before we get to that, let's get you some movers in the pre-market. 3 hours away from your opening bell with Yahara. Hey, Yahara.
Hi, John. We start with the latest retail earnings that just came in, and that is low. Shares are higher, 2.7%. They did have solid results. Comparable sales did dip in the latest quarter, but not by as much as what was expected. Plus, it boosted its full-year comparable sales forecast. So what Lowe's is telling us here is that shoppers continue to flock to its stores for its home products despite all the noise we've been hearing around the economy. Next up, staying in the home space, we have Toll Brothers. Those shares are up more than 5% here. The results were mixed for the luxury home builder because while demand was soft in the latest quarter, it did beat on the bottom line. Plus, it also stuck to its full-year guidance. CEO Douglas Yearley pointing to fierce demand for new homes amid limited supply. We've heard that before. Plus, a high-end market that he says shows no signs of cooling. And last up, we have a downer. Wolfspeed absolutely plunging here, down 55%, as the Wall Street Journal is reporting the company, which makes chip components, is preparing to file for bankruptcy within weeks. Not only has it been struggling with a high debt load, but it's also faced weak demand from the auto sector, and it's been caught up in all this tariffs uncertainty. So Wolfspeed is expected to file for Chapter 11, according to the Wall Street Journal, with backing from most of its creditors. John?
Yahara, thank you. Appreciate it. Here's another mover, Target. The numbers just dropping. The numbers aren't great. It's a miss on sales and a cut to the outlook. They now see full-year sales declining by low single-digit. They had previously seen growth. That stock is down at the pre-market by 1.65%. Not great numbers from Target this morning, Danny.
It's really not, and it's interesting to look at what the CEO is blaming this on. He talked about multiple things: discretionary weakness, declining consumer confidence, uncertainty over tariffs. But John, I'm not sure how much you can blame that in this current environment for the current results. When you see the likes of Walmart still posting strong reports, Home Depot, Yahira was just talking about Lowe's. So I think you're going to have in this moment companies using the uncertainty among consumers as a catch-all, but can you really do that in this moment?
You need to be super agile in this moment. It's interesting they're establishing a multi-year enterprise acceleration office, and the office is to drive even greater speed and agility across the office of the company.
It's what we've heard of these various companies putting together task force, trying to figure out how they right-size their supply chain. It is a moment we hear again and again of uncertainty. How much are they thinking about what they need to do with their stockpiling? How much are they pulling things forward at this moment with a target that's especially difficult if demand is really low? Do you really want to load up the boat and get all of your products into store now?
We'll come back to that company in just a moment. Target reporting earnings just moments ago. cutting their outlook and sales coming in lighter than expected. On our radar this morning, elsewhere, President Trump's big, beautiful tax bill hitting a stalemate in Washington. Sources telling us here at Bloomberg that Trump is growing frustrated about calls for raising the SALT cap. Elsewhere, G7 finance chiefs gathering in Canada. Canada's finance minister saying leaders are discussing tariffs on oversupplied and low-value Chinese products, adding that talks would include how countries can coordinate to curb Chinese oversupply.
It's not a surprise at all, because this is something which many countries had fear, that you get rid of the de minimis rule in the U.S., where do the cheap Chinese goods go? They need to go somewhere. We've seen again and again in the data in China that exports are so crucial to them. This is something the EU had been grappling with 2 years ago. They had thought about also removing their de minimis rule, but you needed the action from the US to really prompt this from the G7 nations. So we're finally starting to get movement there, but what happens in the meantime? What degree do we see cheap goods flooding these markets?
Peter Schiff's still with us. Pete, isn't this precisely, almost exactly what the US has been calling for years now?
Yeah, and I think the other flip side of it has been, we've been talking about China's only way out of their own economic morass is to export their own brands, right? So we've been calling this shift from made in China to made by China. So I think they're going to continue to push that, and they are going to look to Europe. More and more, though, it's really the emerging markets that I think they're really trying to push into. That's where they've got these ties with the autocratic, resource-rich nations. China's importing a lot of raw material. They are trying to export their brands. I think that's their only hope. They're trying to push this. This is a setback to them. I don't know how successful we'll be on pushing back on them, but that to me has been the big concern, is China trying to sell their brands globally and compete with our brands globally. This will put a dent into that, but it's still their long-term strategy, and I'm not sure how willing we are to live with this for very long.
Pete, since you're with us, I wanted to turn to this story as well. The CNN report that Danny mentioned about 30 minutes ago, that Israel is preparing to strike Iran's nuclear facilities. U.S. officials saying it's unclear if Israel would ultimately carry out the attacks, and a final decision has not yet been made. Your company, as we often say, is full of generals. What are they telling you about the situation in the Middle East regarding this?
Yeah, so this is something we talk about a fair bit, and I'm lucky enough to work with 30 retired generals and admirals, and we do a lot of red team, blue team, so you try and play these things out. I think the consensus is it would be very, very difficult, if not impossible, for Israel to do this without direct support from the U.S. They really need our equipment. They need our things. The other thing that concerns me a little bit is, Ben, I think they look like the odd man out on this recent trip, right? When Trump was in the Middle East, he really did not do anything to Israel. And then the final part of this is maybe everyone's now just learned this maximum leverage thing. So you say the utmost aggressive thing possible to bring people to the table, and I think that's unfortunately becoming a status quo in the world right now, is everyone's read Art of the Deal, and everyone now knows you just say the most outlandish thing or most aggressive thing and see what people do.
Well, that's the thing. The background of this at the moment was the U.S. and Trump being very clear that they wanted some sort of agreement with Iran, with nuclear talks. I think it was really interesting that this report suggested that it came from U.S. intelligence sources, not Israeli. Is there a sense to which this is the U.S. saying, hey, we are not involved in this. We are trying to warn you to some extent in order to make sure that some sort of talks can still be ongoing?
Well, I think some of this is still even going back to the Biden administration, where we tried to tell Israel how to prosecute the war. And I think if you look at this from an Israel standpoint, they have Hamas back on their heels. They have Iran back on their heels. They've demonstrated this ability, and they are horrified that one day Iran becomes a nuclear power, and that whatever's put in place, they get this. So I think from an Israel standpoint, you can kind of see that they're saying this might be our one chance to truly stop this and nip this in the bud, and that's not suiting our agenda. It's not suiting what the rest of the Middle East wants. So I can see there's some tension, and maybe, again, this is just a negotiating ploy for Israel to get some attention from the U.S. and get something they want.
Well, to that point, Pete, do you think these extreme headlines that have built up repeatedly over the last month have begun to have a dampening effect on price action? The fact that crude is up by not even $1 this morning off the back of this kind of speaks to that.
Yeah, I think we're all learning whatever people say is now just the starting point of some sort of negotiation. Everyone's kind of playing the same sort of game. It's a scary one because you're not quite sure what will happen. We went from India, Pakistan to relatively, calmish neighbors to everyone talking about the risk of nuclear war back to calm very quickly. So I think those things were overstated. So I think we are dealing with that. But the risk is that we become too complacent and one of these things sneaks through and all of a sudden like, ooh, we just went somewhere we did not think was possible.
And 60 is not the right price for crude at that point.
No, not at all.
WTI right now, 62.61. Brent crude, 65.94. That's the situation in the commodity market. Let's turn back to Target. The retailer reporting a miss on sales and cutting its outlook. Sucharita Gedalia Forrester joins us now for more. Sucharita, welcome back to the program. I just want your opinion on Target first. Is this a Target problem or a retail problem?
Well, it's both. Virtually every retailer, with Lowe's accepted this morning, has really expected struggles in the year to come. We saw that with the Walmart announcement. Lots of questions around what is the impact, of course, of tariffs and the uncertainty in the economy. And Target is not immune to any of those concerns. Target also has had serious execution issues. While Walmart stock has been doing pretty well, Target's at more than a 5-year low. So that really suggests, and it has been for several months now, which suggests that there are serious execution issues and store operations issues that need to be dealt with, even outside of everything related to the economy and tariffs.
But they're not in a vacuum, Sucharita. They do have to deal with what's happening with the economy and tariffs. How much more difficult or how much more does it delay their timeline for right-sizing, for getting those operational issues fixed, when they are potentially dealing with some serious demand loss because of what's happening in the economy?
Right. It is absolutely a perfect storm in many ways for them, because they certainly have their own internal issues. In addition to the numbers that they released today, there were a lot of personnel changes that they announced. Who's going to head this new committee to rejuvenate the company, merchandising changes. So lots of shift at the leadership level that will be attempted. But at the same time, to do that in the face of not knowing what the price of products may even be in the next 6 to 12 months during critical time periods like Q4 is going to be an additional challenge. And they don't have as diverse of they don't have as much success with .com, although the .com comps were decent. They're not as heavily invested in it as Walmart. Their retail media business, which is a profit pool that could potentially offset things, is not nearly as large as Walmart's or Amazon's. So it absolutely is a challenge that they are going to struggle to overcome in the coming year.
When it comes to these retailers trying to figure out their supply chains, Home Depot, I thought, was really fascinating yesterday, Sucharita. They said at the moment it sources about 50% of its products in the U.S., but it said over the next 12 months, it expects that products coming from outside the U.S. will be no more than 10%. Sucharita, how realistic is that, not just for Home Depot, but some of these other retailers to try to do something similar?
Well, I think that what we're seeing is a lot of announcements to try to lend confidence to the markets that supply chain issues won't be as much of a factor, at least in terms of the receipt of goods. Whether or not that actually happens, I think remains to be seen. There is so much that needs to go into shifting suppliers from even one market to another. You have to deal with so many issues related to compliance. Some of the things that retailers are telling me is that, candidly, it's very difficult to shift out of some of those East Asian markets because the factories often are very good with the compliance laws around just ensuring that the products they meet the standards of wherever they're being exported to. And often the U.S. does have some of those higher import standards that those factories are uniquely suited to address. But the other issue, though, is what concerns me about the Home Depot announcement is when you say that it's only going to be 10% that's going to come from overseas. I worry about inflation because that to me suggests that prices are likely going to go up.
Sucharita, we've got to leave it there. What a difficult moment for retailers. Sucharita Kodali there at Forrester. If you're just joining us, welcome to the program. Target out with numbers, much weaker than expected, and a cut to the outlook as well. The stock is down by 1.7% in the pre-market. Pete, I just wanted a final word from you, sir. There's a word that we hate on this program, idiosyncratic. But whenever you get numbers like this from a retailer, we can say it's unique, it's retailer specific, it's about Target, not about the sector or the economy, the consumer. How are you getting a clean read on the consumer in America right now?
It's really difficult. I think you're trying to look at things like delinquencies, et cetera, and it feels like the top end of the consumer is still doing quite well. The lower end is not doing so well, and you're trying to figure out which way is bleeding more. Is it going to bleed down? I think it's a little bit fragile out there. I think, getting this big, beautiful bill will help with confidence. I'm a little bit concerned, and for the first time, too, I'm starting to look at Does it matter if you're in a red state or blue state? Again, I keep coming back to when you look at anything in this economy and you do any sort of subjective data, Republicans are saying it's great, Democrats are saying it's awful, and I'm not sure if that means differences for your stores, for where you're selling things. I feel like it's pervasive, though, and it's just an extra layer of getting difficult things to read through. I think the economy is weakening. I think it was weakening before all this. I don't think it's going to be great.
I think it's fair to say that you, Mitch, is more of a political poll than it is an economic survey at the moment.
Well, if you have some surveys of the Democrats and you, Mitch, expecting 11% inflation, and you've had readings of nearly 0% for Republicans, I think, yeah, you can make that assumption.
Pete, we've got to leave it there. Good to see you, sir. Peter Chair of Academy Securities with an update on stories elsewhere this morning with your Bloomberg brief. Let's cross over to Yahara. Hey, Yahara.
Hi, John. Recapping those Target earnings, shares are lower by 0.3% after Target cut its sales forecast following a weaker than expected quarter. The CEO citing weak discretionary spending, tariff uncertainty, as well as backlash after the company dropped diversity initiatives. However, e-commerce and same-day deliveries were a bright spot for the retailer. Meanwhile, Lowe's shares are rising in the pre-market. They're up 2.6%. The home improvement retailer reported comparable sales that dipped 1.7% in the first quarter, but that was better than what analysts were expecting. Lowe's also maintained its guidance for the full year. The results showing shoppers maintained home spending despite weakening consumer sentiment. And UK Chancellor Rachel Reeves and U.S. Treasury Secretary Scott Bessent are set to meet this week on the sidelines of the G7 finance ministers meeting in Canada. The two will work on finalizing the details of a trade deal announced earlier this month, including carve-outs for Britain's auto and steel industries. That's your Bloomberg brief. John?
Yahara, thank you. More from Yahara in the next hour. Up next, recommitting to Tesla.
Do you see yourself, and are you committed to still being the chief executive of Tesla in 5 years' time?
Yes.
No doubt about that at all?
Well, no, I might die.
That's one way of putting it. Dan Ives of Wedbush joins us next. Live from New York City, this is Bloomberg.
Incidence of cancer, which is to say people getting it, is higher than it was 20 or 30 or 40 years ago. Is that because detection is better than it used to be?
All right, so the dirty secret is we have no idea. We don't collect data well in the United States. What we do know is that there's not a dramatic rise in cancer in the United States, but what we are seeing is a troubling trend is younger people are getting more cancers. That's real. We have no idea why, but we are seeing younger people, more colon cancer, more breast cancer, and other cancers in younger individuals, 20, 30, 40-year-olds, that we never used to see.
What do you think could possibly be the cause? I assume pollution or the environment in some ways?
We assume it's either something in the environment, we assume it's diet, it's ultra-processed foods, it's microplastics, it's changes in the microbiome. We really don't know.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Our global headquarters in New York.
York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
Bringing you the latest in tech and AI news whenever and wherever it happens. I'm Tom McKenzie in Paris, and this is Bloomberg.
Snapped a 6-day winning streak on the S&P in yesterday's session. Over those 6 days, up by more than 5%. Yesterday, down about 0.4%. So a tiny correction. This morning, we're down by 0.75% on the S&P. On the Nasdaq, we're down by 0.75% also. Keep one eye on the bond market, as always. Check out the long end of the curve. Yields up, the curve steeper, up 6 basis points on 30s, 5.02%. These are the kind of levels we've been in and around, Danny, over the past few sessions. We've struggled to close here. This is the level to watch.
Yeah, no one seems to want to be a buyer around 5%, but there has been a lot of chop in equity markets, a lot of chop elsewhere, except for the long end of the curve. And again, I think this is so notable that April, you had this big surge upwards in yields. It comes down. It has been a very, very easy trend in May that it's orderly, you keep moving higher. Does that suggest that this has more durability than what we saw in April? And that, I think, will be concerning, not least to market participants, but also to what's happening in Washington, D.C.
Yields up and the dollar weaker. That's what spooks people. Yields up this morning. The dollar weaker against the euro. Euro dollar, 113.47. Under surveillance this morning, recommitting to Tesla.
Do you see yourself, and are you committed to still being the chief executive of Tesla in 5 years' time?
Yes.
No doubt about that at all.
Well, no, I might die.
I wonder if some of what has happened to Tesla in the last few months, did you take it personally?
Yes. In terms of political spending, I'm going to do a lot less in the future.
And why is that?
I think I've done enough.
So here's the latest this morning. The Tesla CEO, Elon Musk, doubling down on his commitment to the EV maker and pulling back from politics. Bloomberg's Craig Trudell joins us now for more. Craig, great that he's recommitting. He is that company, without a doubt. He is the success that company has had over the last decade or so. Craig, as he goes back, what is the problem, the number one issue he's got to fix?
I think one of them, just based on yesterday's conversation, is maybe looking at the state of Tesla a little bit more clearly, because it is not turned around as Musk suggested yesterday, and one needs to look no further than I would say particularly the state of their sales here in Europe. I think for Musk to suggest yesterday that there are no exceptions, everybody in Europe is having a hard go of it. It's just, false. And, until and unless there's an acknowledgement, that they have a problem, it's hard to wrap one's, mind around or get comfortable with the notion that they are going to set out to fix that problem. I also think, the way that he spoke about, sort of people in opposition to Tesla is unlikely to, endear or sort of mend fences when, he talked yesterday about the idea of, if those of you attacking my company, we're going to come after you. That wasn't the sort of tone that you would maybe hope to hear if you want to see him kind of change the way he's going about, presenting himself to the public and potential car buyers.
Craig Trudell out of London. Craig, appreciate the update. I want to turn to a Tesla bull, Dan Ives of Wedbush, who has an outperform rating on the shares and a 350 price target. Dan, do they have an operational problem or a reputational issue? And how easy is it going to be to fix?
I mean, I think it's a big step forward that we saw from the earnings call, from the Musk recommitting to Tesla. And I think these interviews that we saw yesterday, it's another huge step forward, because to me, you're talking about with NVIDIA, two of the biggest disruptive technology players in the world in terms of autonomous and optimus. So I view it, is there some brand damage? We've said there is. But I don't view it as something that it really changes the game going forward. And I think now demand starts to rebound in Europe, demand starts to rebound in China, and Musk is Tesla, Tesla is Musk. Tesla got back its biggest asset, doubling down here.
So, Dan, does that mean when Elon Musk said yesterday as to how he would turn around the company, and he said, oh, it's already turned around, that you would agree with that?
I would. I mean, look, we've talked about on the show. I mean, It was a dark period when he was a Doge. We went through that. He ultimately was a fork in the road. Clock struck midnight. He picked Tesla. And now I believe that path to 2 trillion market cap is on the table because of autonomous and robotics. And I just believe now you'll still have some chop in terms of demand in near term. But I think overall, this is going to be a golden era for Tesla.
Dan, there'd also been this bull case after the Trump election, why you saw Tesla surge so much. And that bull case went something along the lines of easier regulation for Tesla, that he had the ear of President Trump. If we are seeing Elon Musk starting to pull back, not spending as much in DC, not as present with Doge, does some of that need to be priced out as well then?
Yeah, look, it's a good question. I mean, obviously, Doge took on a life of its own. I think Musk recognized that in terms of some of the brand damage, which is ultimately why he had to leave Trump White House. But in terms, I do believe you are going to have less regulation. I think the pathway to autonomous is going to be there on level 4, not just for Tesla, but for Waymo and others. But I don't think it's priced in. I do not believe the market is fully pricing in the opportunity in terms of autonomous and robotics for Tesla. And I think what we saw from Musk, that's a different Musk. That's a committed Musk. Look, leaders lead, and that's what Musk is doing.
The issue down at play then, if you believe the long-term valuation comes down to autonomous, most people do. They agree with you. You've got to understand whether it's a regulation issue or a tech issue. And if you look at Waymo, Dan, it doesn't look like a regulation issue for the likes of Waymo. Waymo's now doing 250,000 paid rides a week. A few years ago, that number was 10K. Dan, how much of a challenge is coming from Waymo?
Look, I mean, Waymo are $230,000 cars, and they're essentially in 4 cities. I mean, obviously, they'll expand. But I believe Tesla is going to go past Waymo 100 miles an hour in the left lane in the next year. In other words, I believe Tesla, from a market share perspective, given scale and scope and what they could do across the U.S., I think Waymo will be a rounding error relative to what Tesla could do on autonomous. Clearly, Waymo's had the leader. But I don't view that as something that's static. I think Tesla has a huge opportunity ahead of it.
Without a doubt, that can change, Dan, but what are you looking at right now that's giving you that confidence? It's clearly not blind hope, at least it shouldn't be. What gives you that confidence in the moment? What do you see?
I mean, what I see is Austin's going to take off in June. I think you're going to have basically 15 to 20 cities in the next 6 to 9 months. And the scale, I mean, we're talking about a few 100,000 robotaxis into next year, and ultimately something that's going to approach in the millions. And I think when you look again to level 4 and you look at where they're heading, I think that's the new era of growth for Tesla. And that's why it was so important for Musk to sort of, make that 180, refocus on Tesla. And that's what he's done. And I think if I told you a month ago that we'd be talking about this, it would be a dream scenario. I think that's what the stock's reflecting too, from those dark days that we saw, starting in the early parts of the Trump administration from Musk.
Dan, appreciate the update. Dan Ives of Wedbush, still bullish on the name. Is it a reputational issue or an operational one? Because one is much harder to fix than the other, I think, at the moment.
Well, even if it is reputational, which I'm assuming you're saying is less difficult to fix, you have a problem where European sales are really low. You still have President Trump in the White House, who still refers to Elon Musk. How difficult will that be to fix at this moment? Both are not easy, John, I have to say.
Both are super hard to repair. You've got to understand what the problem is, though, before you go about fixing it. And that's the issue at play, I think, for that company at the moment. Up next on the program, Stuart Kaiser of Citi, Romina Bochir at the Cato Institute, Assam Khalil of Goldman Sachs, and the former New York Fed President, Bill Dudley. The second hour of Bloomberg Surveillance is up next.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Why is Baltimore so important to you?
It's our state's largest city. And if your state's largest city is not thriving, your state can't thrive. And that is just a mathematical equation, because the only way this is going to be Maryland's decade is if it's Baltimore's time. And so that's why we did focus on things like being able to extend the Orioles lease and make sure the Orioles could be here for 30 years. It's the reason we focus on things like the Preakness and keeping the Preakness in Maryland for generations to come. While we've invested in the convention center, the reason we focused on housing and getting rid of the vacant housing, the reason we focused on violent crime. And now Baltimore is having amongst the most precipitous drop of anywhere in the country when it comes to homicides and non-fatal shootings and carjackings and auto thefts. So if you can have Baltimore thriving, your state is going to thrive.
So if somebody's watching this and they're not from Maryland, but they want to know a little bit about Maryland, what would you encapsulate in a paragraph or two about what people should know about the state of Maryland?
I would say Maryland really is American miniature. You tell me what you want to do. And no matter where you're standing in the state of Maryland, I can tell you where to have a world-class experience within 2 hours. We're the home of innovation. We're the home of Johns Hopkins University, the home of the NSA, the home of NIST. We have so much to offer in the state of Maryland, and I think it's one of the reasons that people are so excited about the growth trajectory we're on.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
I think the stock market is backward looking at the moment.
We clearly have entered a very volatile period right now.
Corporate and personal balance sheets are in really good shape.
Consumers are really nervous, and so there's a little bit of a pullback.
When consumers start seeing prices going higher, they're not going to be happy. They will pull back.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning to you all. The second hour of Bloomberg Surveillance starts right now, and your scores look like this on the S&P 500. Equity futures just a touch softer, lighter negative. We're down across the board here, down by 0.7 on the S&P and snapping a 6-day winning streak in yesterday's session. We add to those losses this morning. We add to the losses in the bond market too. Let's focus on this bond market. The long end of the curve. Yields are higher by 6 basis points on a 30-year. We're back through 5%. But it's not just a domestic issue. It's not just the United States, it's global. It's Japan, it's the UK. Gilt yields this morning, Danny, higher at the long end by 8 basis points.
It's interesting because George Servelos of Deutsche Bank has been making the argument that the JGB sell-off is a bigger issue for treasuries than it is for the Japanese. You can make the same argument for what's happening in the UK because all of a sudden yields are higher. Yields look more attractive to local investors. So Peter Scheer was making this point too. Why would you go through the headache of converting your money into dollars to buy treasuries when all of a sudden you can get something from your local paper?
Priya Misra, JP Morgan Asset Management, joining the program earlier this week, doesn't want to touch the 30-year. The why? Look at what's happening globally. Look at what is happening in Washington, D.C. Does this tap the brakes as they try and advance that bill down in Washington?
Well, also part of the problem is whatever they get done, is it locked in for the next decade? If you have an issue where in the midterms you might have something that looks more like a split Congress, the reconciliation process is very difficult. Is this their one shot to get something done? And if they get something done and it means higher deficits, can you really reverse it? You might not be able to.
We've got a lot to work through this morning. It starts with this bond market, 2-year, 10-year, and 30-year. Yields up across the curve. more at the long end. This curve is steeper. The 30-year is up by 6 basis points. Coming up this hour, we'll catch up with Stuart Kaiser of Citi, with stocks ending a 6-day winning run. Assam Khalil of Goldman Sachs on the state of the banking sector, and former New York Fed President Bill Dudley on why the Fed should prepare markets for the unexpected. That conversation about 40 minutes away. We begin this app with our top story. The tax debate on Capitol Hill continues. Joining us now from Washington is Anne-Marie. Anne-Marie, we've talked about this timeline. It's aggressive. Can they stick to it?
It's very aggressive, and Speaker Johnson really wants to stick with this timeline. That is why he's at the Rules Committee right now, Jonathan. They've been working throughout the evening into the early hours. The first panel of that hearing wrapped up about 4:30 a.m. So this is going to go into the morning. So Speaker Johnson needs to make sure that this passes through the Rules Committee, and then he can put it on the House floor. And he wants to do all this before Memorial Day. What we are waiting on is the text of these backroom dealings that were done. We do understand, according to reports, that Johnson made a deal with blue state Republicans, a new structure for SALT, lifting the SALT cap from $10,000 to $40,000 for those making less than $500,000. And then also, for those that were worried that this just doesn't do enough, the fiscal hawks, a little bit more conservative, those individuals potentially will get the clawing back of the Inflation Reduction Act tax credits sooner than was original in the bill. But again, we need to wait for this text. And I would argue that at this moment, this is actually the easiest part for Speaker Johnson, because then this bill is going to go to the Senate. And already you had Senate Majority Leaders talk to Jake Sherman in Punchbowl News this weekend saying he thought $40,000 for the SALT cap, that new cap potential. He said that's quite generous. You could see a lot of tweaks happening in the Senate. Then it has to come back to the House, and that is going to be incredibly challenging for Johnson to get the votes after you have the Senate edit their package and their bill. And that's when the closer, the President of the United States, is really going to have to make his pitch to Congress.
Anne-Marie, how effective will that pitch be when he already tried to do it earlier this week, already tried to implore the SALT caucus, as it were, to move forward, and seems like he didn't make much movement there?
Well, I would say it's early innings. When you have an individual like Representative Lawler pushing back, this individual, it's been teased that maybe he wants to run for governor. There is something he wants. So he cannot capitulate so early on. This is the first, second inning of a very long ball game, even though an individual like Terry Haynes of Pangea Policy is saying that he thinks 80% chance this gets done by July 4th. But you have to remember, this is all a negotiation. So every faction, every individual is going to come in with their maximalist approach. And they need to go back to their constituents, think of the midterms, and say, did you see how hard I fought? I even went up against the President of the United States to try to get a higher SALT cap. And I would say that the President yesterday kind of understood this, and he said that this was a bit of a pep talk. He's going to have to make another number of visits to Capitol Hill and potentially even have some of these individuals come into the Oval Office.
Anne-Marie, thank you. And this is just to address the issues in the House before we get to the Senate. That's the view from Washington, D.C. Here's the view on Wall Street. Stuart Kaiser of Citi writing the following. Corporate America and the FOMC are in wait-and-see mode at a time when the signal-noise ratio of economic data is poor. Stuart joins us now from Stu. Good morning.
Hi, good morning.
Memorial Day, very, very close, not even a week away. What are the biggest risks to the summer vacation over the next few months?
Look, I think the one that got activated over the weekend was long end bond term premium kind of blowing out a little bit. I think a lot of investors had that on their radar, excuse me, but thought it was going to kind of be more of a midsummer type issue. The Moody's downgrade and now that kind of failed committee vote late last week, I think kind of brought that to the forefront. To your point, price action is also kind of demanding people focus on it. So I think the number one risk right here and now is that long-term bond term premium. As you get into the summer, I think, as we mentioned there, corporate America sort of punted last quarter. I don't think during July earnings, the street's going to allow them to punt again. So I think as you get into the summer, these potential downside risks to both EPS and GDP become a real issue. But for now, it's all about these negotiations on the bond term premium.
Let's deal with one at a time. Let's start with bonds and the negotiations down in Washington. It's not just the US. Japan, messy auctions, the UK, hot inflation. Yields are up around the world. What do you think is behind some of that, and what does it mean for stocks?
Look, I think our view coming into the year is that long end of the bond curve is going to be impacted both by the deficit and budget tax negotiations as well as tariff policy. I mean, I think there was a view that tariff policy disrupts kind of long-term, steady state trade policy, and to the extent that that gets disrupted, you can get people a little uncomfortable owning that longer-term U.S. credit. So I think it's a combination of both. We have a 20-year bond auction later today, which is clearly going to get a lot more attention than it normally would. So yeah, I think it's a combination valuation of the deficit. Look, deficit to GDP is like 6.5%. Back in 2011, when the S&P downgraded the U.S., it was 8.5%. The difference there is valuation was half what it is now, and you were also coming out of the financial crisis. So that deficit was high for a reason. The issue now, which a lot of economists have highlighted, is the fact you have a very large deficit on the back of a few years of really strong economic growth. So that's really concerning people, I think.
We have price to equity multiples or something, price to earnings multiples or something above 20 times right now. It is pretty remarkable, and you point out we still face trade headwinds. Even if things stay as is, that is a significant increase in what tariffs look like. Are we underpricing the real economic damage, the real damage to corporations that might come from having to pay higher prices?
I think investors are really concerned about that, just because even if you're at 10% across the board and call it 25% on China as a broad number, that is still a significant increase, and it still has potential downside risk to earnings in particular. As I mentioned, I think people were comfortable allowing companies to punt for a quarter to get a little more information because investors themselves didn't have enough information to kind of argue with them, I guess you would say. As you get into July, I think that's really going to come to a head. And we're going to have to see what happens. To be fair, though, there's a group of investors that believe we're going to a recession, right? And, an economist probably tell you that number is between 30 and 50%, give or take. There's also, though, a group of investors that say, look, that risk is well understood and fully priced. Are we underpricing the idea that this economy, may be more resilient than expected? So you've kind of ended up with these two camps out there, and those folks are the ones that are creating the volatility in the market.
Well, one of the other arguments that had started out this year as to why perhaps U.S. equities wouldn't do as well is because the money was flowing into other markets. But even though U.S. equities have started to rally, the DAX still closed at another all-time high. The Stock 600, that's closing in on its records too. What do you make of stocks in Europe still exhibiting so much strength at the moment?
I think part of that is, frankly, the fiscal. A lot of people did not expect Europe to do fiscal and defense spend, and they were able to kind of push that through in Germany. And I think that was a little bit of a game changer for longer-term investors and real money. So I think you're seeing that go in there. And some of it, to your point, is just a little bit of discomfort with the U.S. and the uncertainty here. So you sort of have an uncertainty bit taking money out of the U.S. You have, potential game changer on fiscal in Europe kind of, pushing them higher, and that combination has been really powerful. We're going to have to see. You haven't had an extended period of Europe outperforming the U.S. for, almost 20 years at this point. So it's going to be really interesting to see 3 months from now what that conversation looks like.
Morgan Stanley capping it at half a year. Mid-year outlook. They say this morning. U.S. over rest of the world. U.S. stocks to benefit from earnings revisions troughing in the near term and dollar weakness. How important is the dollar weakness going forward?
I think it's why you're getting that dollar weakness. When you get gold moving as aggressively higher as it has been, I think that's viewed as sort of I want to be short the dollar, but I'm not sure what other currencies I want to be long. So, to the extent that you keep getting gold higher, then I think the dollar weakness is arguably a risk factor as opposed to just sort of being driven by fundamentals. So I do think the why will matter there. In terms of earning revisions, we'll have to see. I mean, U.S. numbers have not come down that much quite yet. And if the 2/3 of companies that didn't guide down ultimately get forced to by tariff policy, then you might not get as much of an earnings uplift as you're hoping for. But again, it's investors we talk to, I think, generally have said we're less overweight the U.S. than we have been a while, and it makes us deeply uncomfortable.
We got a cut to guidance this morning. Target, sales weaker than expected, cut to the outlook. Stock is down in the pre-market by 4.5%. What's your read on retail? What's your read on the U.S. consumer?
Yeah, I mean, retail is an interesting one. If you go, you have Target and Walmart have kind of been, two of the big bellwethers there. I think, Walmart's message was in a post-tariff environment, our pricing advantage is at least as wide. And maybe what you're seeing from Target's numbers is a little bit of a confirmation of that. I do think investors are sniffing around for what in the retail space can I own? and Scott Cronert on our equity research team has kind of done that work. And there are stocks there. The question is, how much bravery do you have to kind of step into those stocks ahead of what could be, a difficult summer from a spending perspective? The tough part here is if the unemployment rate ticks higher in early June, is that signal or noise? And again, I don't know how the market's going to deal with that. I would assume, and Bill Dudley later may have a lot more insight into this than I would, but I mean, it seems like for the time being, the Fed is going to get a little bit of a pass on this data, at least for a couple of months. So it makes it even harder to read the consumer because the incoming data, again, could be signal, could be noise, and it's hard to determine.
Danny, this is so important because if we do get that weaker data, there are some people who think it's dated. because we've just had the truce between the US and China, and they believe the policy front improves from here?
I think a lot of people will look at the data and say it is extremely distorted at this moment, much like we have for most of this year. If you get this pull forward of not just companies trying to ship things in, but also consumers deciding that they need to get out now before an increase, how much can you really trust it? Are we really going to continue to trade off of it? How much is the Fed going to trust it? They've told us as much, that they're waiting maybe until months, maybe until September to really start reading into it.
Bill Dudley, the former New York Fed president, 30 minutes away. Stu's going to stick with us. Stuart Kaiser of Citi. Equities at the moment recovering. We're down by 0.6% on the S&P. With an update on stories elsewhere, here's your Bloomberg Brief with Yahara Anand. Hey, Yahara.
Hi, John. The U.S.-China tariff truce triggered a sharp rebound in trade activity. Container bookings to the U.S. more than doubled in the week beginning May 12th, and shipping rates from Shanghai to L.A. jumped by the most this year. Prices for space on ships across the Pacific into the U.S. also rose, with spot rates from Shanghai to Los Angeles jumping about 16%. Meanwhile, CVS is rolling out new ideas to boost vaccinations. Sources telling us here at Bloomberg the company is incentivizing staff with bonuses and raffles, plus it's phoning and texting customers to encourage vaccinations. The move comes as the FDA says it will no longer approve COVID booster shots for healthy adults and kids. And Elon Musk plans to cut his political spending after spending approximately $300 million to back Donald Trump's presidential campaign. Speaking to Bloomberg at the Qatar Economic Forum, Musk did not rule out future political contributions, saying, if I see a reason to do political spending in the future, I will do it. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. More from Yahara later this hour. Just staying on the Qatar Economic Forum in Doha, Bloomberg in conversation with CEOs about navigating volatile markets. Bloomberg subscribers can tune into the interview on LiveGo on the Bloomberg terminal. Up next on the program, Trump looking to strike a deal.
So this is the biggest tax cut in the history of our country. We're not doing any cutting of anything meaningful. The only thing we're cutting is waste, fraud, and abuse.
Up next on the program, an agreement, potentially, between Speaker Johnson and the holdouts, coming to an agreement for a $40,000 SALT deduction cap. We'll get you the latest reporting down in Washington, D.C. in just a moment.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Live from New York City this morning. Good morning to you all. Equity futures on the S&P recovering somewhat. We're down by 0.6% in the bond market. This is the one to watch. Yields on a 30-year, higher by 6 basis points. The 30-year this morning, 5.03%. Under surveillance this morning, Trump looking to strike a deal.
So this is the biggest tax cut in the history of our country, or you'll get a 68% tax increase. And if that happens, I mean, what Republican could vote for that to happen? Because there wouldn't be a Republican much longer. They would be knocked out so fast. We're not doing any cutting of anything meaningful. The only thing we're cutting is waste, fraud, and abuse. I'm a cheerleader for this party, and I'm a cheerleader for the country. Much more importantly, for the country.
That was the push from the president yesterday. Here's the deal this morning. House Speaker Mike Johnson saying the House has come to a $40,000 SALT deduction cap agreement. Anne-Marie joins us now from Washington, D.C. with the latest reporting. Hey, Anne-Marie.
Hey, Jonathan, that's right. The Speaker Johnson this morning basically saying what we've been talking about all morning in reports, that they have come to this agreement with the SALT faction to raise the SALT deduction from $10,000 to $40,000. And discuss all of this is Romina Baccia, Director of Budget and Entitlement Policy at the Cato Institute. Now, Romina, this just came through that the Speaker has talked about, that this is what they've agreed upon. We haven't seen the text. But I know you recently tweeted that the idea of expansion of SALT gives you high blood pressure. How would you expect, then, the Speaker to get some of these blue state Republicans on board?
Well, the blue state Republicans are already on board. The problem we have with this bill is, as President Trump said in your clip, they are not making any meaningful spending reductions. We're looking at a $5 trillion debt increase over the next 10 years, which would add fuel to the fire because we already have a built-in more than $20 trillion debt increase under the current Congressional Budget Office baseline. So this accelerates the debt by an additional 25%, and the current negotiations, even after Moody's downgraded the United States debt just last Friday, are moving in the wrong direction. There's the potential for an even bigger debt increase now that Republicans are talking about expanding the state and local tax deduction so significantly, which, by the way, is just a handout to campaign contributors. So it's a symbol of what's broken with this process. Instead of pro-growth policies, we are seeing these tax giveaways that primarily serve the purpose of currying favor with favored constituencies.
Right, but I think a blue state Republican would say that those states contribute to the most of the federal government. I believe New York gives like some $90 billion to the federal government, more than they take in. And if this bill does not get passed, though, the cap goes back to pre-2017 TCJA, and there is no cap. So how do you think they should work around this, and what kind of agreement would you suggest?
First of all, it's not the states that give money to the federal government. It's American workers who are earning that money. And there's no reason why taxpayers in other states like Texas and Alabama, for example, should be picking up a larger federal tax tab in order for states like California and New York to be able to be fiscally irresponsible. That's the whole debate over this SALT deduction, is who should bear the burden of federal taxes. Of course, ideally, we would reduce the size of the federal government, reducing spending, which is excessive at $7 trillion, with deficits in the 6 to 7% of GDP range and rising. We're already paying $1 trillion on in interest costs on the U.S. national debt. And if this bill passes and bond markets continue the way that they have, with rates staying much higher than the CBO initially projected in the 4.5 to 5% range, we could be paying more than $2 trillion in interest alone by the end of this decade if this bill passes. So federal taxpayers cannot afford to subsidize blue state Democrats or Republicans.
They're clearly not going to be addressing the deficit in this bill. And to your point, interest on debt is currently the fastest growing part of the U.S. budget. So after this bill likely passes, what's your advice to them to try to get our fiscal house in order?
Well, right now they shouldn't be passing such a bad bill, because we've already heard from markets, we've heard from Moody's, which has downgraded us because of this fiscal unsustainability that we all know is going on in the federal government, and our political system is showing absolutely no signs of slowing down the borrowing. And this is going to continue to rattle bond market holders, and we could have a U.S. trust moment where politicians should be making an about face and actually making meaningful spending reductions and pulling back on some of those tax giveaways, including no taxes on tips or the SALT deduction. But if they decide to proceed with this bill, I say put in place an independent fiscal commission, perhaps modeled after the Base Realignment and Closure Commission. You might call it a Budget Realignment and Control Commission. But I think the politicians have demonstrated that they're not willing to make the